right. All right, folks, we're gonna go ahead and get started.
I don't know. I don't want to interrupt the interesting conversation. Good to see you guys. So good morning, everyone, and welcome to our 4th annual Stakeholder Forum. And I'm pleased to see all of you here today in the Fechner Auditorium, newly named last month, for our longest-serving board member, Rob Fechner. So I also want to thank you guys who are watching online, so welcome. We do host this event because CalPERS is committed to working transparently with our stakeholders. This is the first of many opportunities you have to hear directly from our teams and to interact with the board to address your concerns throughout the year. So I'm joined by several of my board colleagues. I think most of my board colleagues are here, so I'm going to introduce them. I'm going to start with Kevin Palke, representing C Schools. David Miller, representing CAPS. Lynn Paquin for Controller Cohen. Arena Ortega, State Personnel Board. I'm sorry, CalHR. Lisa Middleton. Yvonne Walker, representing retirees. Jose Luis Pacheco, representing, I think, all of us. Frank Rufino, representing Fiona Ma's office. Jose Luis Pacheco, I'm sorry. Ramon Rubalcava, I just said that. And Melissa Willett, representing cities. I just wanted to do it all over again. As president of the board, my colleagues and I work together with the CalPERS leadership team to set the strategic direction for the fund. As questions come up from this forum, our board proceedings going forward, we will welcome your questions by email throughout the year. You can call us. I know you guys all know that. Looking ahead, I welcome you to join us for future board meetings in person and online. They are webcast, so you can watch online from the comfort of your office or your home if you choose. To further enhance your CalPERS education, we also offer a number of online classes and some in-person benefit education events throughout the state. Again, thank you all for joining us. Welcome, and I'm going to hand it over to David Takers now. Thank you.
Thank you, Madam President. Hand this off. Pardon me.
You don't need it.
All right, welcome everyone. Just want to run through a little bit of housekeeping and the format for today's forum because we've got a very complex, sort of many moving parts forum planned for you here. This is actually the 4th annual forum that we did. We did the first one in the good old days where we just had the meeting in person, and that was it, believe it or not. Just in person here on the campus. It seems like a different century. Then, of course, the pandemic, and we had to pivot, and we did the most basic sort of webinar format. Then in the 3rd year, we said, okay, we can flex our technological muscles a little bit here and do at least an interactive sort of Zoom format. And then this year, we have got an in-person format, and we've got over 100 people right now. There's more than 300 people actually registered for the Zoom portion, which is causing problems right this instant. And then 3rd, we are also simultaneously webcasting this. All right, so now it seems like a good time to say, if you are watching this on Zoom, please go ahead and actively mute yourself right now. We will wait. Go ahead and mute yourself until you wish to speak, which I'll describe in a second here. Our goal here is to try to have as much of an interactive dialogue as possible given the physical and technological constraints that we're dealing with here. So the Zoom folks are not in a darkened theater type of webinar experience. They can obviously see and hear each other. We can see and hear you folks on the Zoom here in the auditorium. The board members are here. We've got probably, I'd say, 60 stakeholders in the room here in the auditorium. So we're going to risk chaos a little bit here. You guys are not forcibly muted. You can all talk. You can have your cameras on or not. That's up to you. But we are going to try to have as much of an interactive in-person and virtual hybrid dialogue as possible with approaching 350 people. So pray for us. In and out. So moving now to sort of like the format, we have broken up the forum into 4 general segments that we think will hit on areas of interest for most of the stakeholders that are involved in the CalPERS universe. The first one will be sort of an overview, state of the system type of conversation spearheaded by our CEO and 2 other of our senior leaders. Then we'll move more into a focused conversation on the investment area with a specific focus on private markets, which are hugely important to our plan to achieve our returns to fund the system. After that, we'll pause for lunch. And then we'll reconvene early in the afternoon and we'll do a session more focused on the operational piece of CalPERS. So this would be, a lot of this focus will be for the folks who, by virtue of their job, engage with CalPERS every day. So the employers, we have a lot of employers registered for this forum this time around, much more than in years past. So these are the folks who work for the cities, the counties, the special districts. They're members in their own right, so they have skin in the game from the member perspective, but really their job is to be focused on CalPERS, pensions, and healthcare. So we'll divert the conversation that way, and then we'll end with a conversation on our healthcare piece. Many of you are probably going to be here mainly for the pension side. You might not even realize that CalPERS is the largest purchaser of healthcare as well, and really our healthcare problem could be a State Department in its own right. But it's often kind of subsumed by the pension conversation. But we're going to do everything today. All right.
They can't hear you on the call, so let's try to.
Okay. All right, people on the call, I promise you I was very witty. So what we're going to do here, we'll just get into the housekeeping piece since I don't want to take up too much time here. What we want to do in terms of how we'll run this is we'll have some kind of preset conversations here, kind of explore some of the main questions that we know the stakeholders have on the various topics. But we also want to encourage dialogue and comments during those sessions as well. So not truly public comment here, but rather if you have a question, you can, if we're in person here, if you'd like to raise your hand, we have a mic in the middle of the room, or if you can just kind of shout it out real quick and I'll articulate it for the folks on the Zoom, we can have that conversation during. Also, folks on the Zoom, if you want to chat in your questions or send it to me directly, I can articulate your questions for you. I'll be kind of manning the mission control of the Zoom here. Or you can raise your e-hand. If you kind of look at your Zoom interface, you can raise your hand, and then I'll be able to call on you, and then you can unmute and ask your question verbally, so however you want to handle it. And then kind of, I will just say, the little bit of a clunky piece that we just have to deal with here by virtue of this being a public meeting is that even though we're going to try to have these interactive, normal human-sounding interactions during the conversations, at the end of each segment, we will need to pause and take formalized public comments if there are any. So the same normal rules would apply to that. 3-minute time limit. We would take the people in the physical auditorium first, and then we would do the Zoom, and we do have this being webcast with the normal call-in function there too. So for any folks that are watching on the web, if you're not in the Zoom, you would need to call the number that's posted on the website, get logged in through that process, and then we'll be able to take your public comment. And we would all hear you here in the room, just like we would in a regular board meeting, okay? All right, so I think that's the general gist of this. Apologize for the technical problems for the folks that are on the Zoom. We're gonna start off with our first panel now. So let's go ahead and do that. Let me introduce our first panelists. Many of them will be no strangers to you who are involved in this game. We've joined first by our CEO, Marcy Frost. We've got our Chief Operating Investment Officer, Michael Cohen, and then we've got our Chief Actuary, Scott Tarando. And we've been logged out up there. So, but Marcy, we can start off here. So, thinking from that kind of 20,000-foot perspective, what are the big priorities, issues, and key things that you're looking at when you're thinking about talking to the board about the financial health of the system? What are you monitoring? What are those big things?
Thank you, David. And everyone, hear me okay?
All right, very good. And so it's really nice to get an opportunity to see you all. It's been a while since we've seen so many faces in the auditorium, so thank you for coming today. For us, the top priorities of the system really don't change that dramatically from year to year. We're always concerned about meeting the assumed rate of return, which sits at 6.8%, and that is a tall order in the markets that we've seen be quite volatile over the last 2 years in particular. A key risk to the system that we identified about 4 years ago, I would say, is the employer affordability. And I know we have a number of employers in here. We try to spend as much time as we can with as many of our 3,000 public employers. And the affordability of the system has become a real risk. And we hear you. We've heard that for the last 3 to 4 years. And I hope we've been able to address some of your concerns with either development of tools or giving you access to more information, including dashboards, webinars, pension tools. And I know Scott will go through some of those tools that were created specifically for the employer community. Sustainability of the fund, I can put sustainability really at the top of the key goals or the key priorities because everything we do is around sustainability. We are essentially an evergreen fund. We have pension payments that are expected to be paid for generations. So even though we have to forecast what we think those pension payments and those liabilities will be and then bring that back into present day terms and figure out how do we fund this system for the long term. That sustainability of the investment, sustainability of having a strong, talented team at CalPERS to run the operations, to run the investment side, to run our healthcare side, extremely important to all of us. Exceptional healthcare. We had a really long panel yesterday, a very interesting panel on the ACO REACH program. And it just shows you, I think, the level of interest from our stakeholders, our members, our beneficiaries, that the changing nature of the healthcare landscape, whether that's the federal government implementing new policies, whether it's CalPERS and our rate negotiation, and we continue obviously to see rates, keeping below medical inflation generally, but the rates continue to go up. So when we think about affordability and sustainability, healthcare certainly plays in there quite right alongside pensions. And then we have to always watch for operational risks. We run the most complex pension system in the world. And that's based on all the various rule sets, various options that are available to all of our members, our retirees. And complexity does drive some cost. Complexity does drive a lot of confusion. And so typically when we're interacting with our members, we do a lot of classes trying to get people a little more interested in their retirement earlier in their career is really important to us. So any ideas that you all have about that we could be doing that differently, we would love to hear it as well. But minimizing those operational risks so that we have the credibility, we have the reputation, that people trust what CalPERS is doing, that's something that is always top of mind for my team as well as for the board. So I would say generally those are the top priorities. Again, they don't change that dramatically from year to year.
Okay, thank you. Turning to Michael, when you were serving as our chief financial officer, you oversaw the big 4-year asset liability management process where we kind of calibrate what we expect to have to pay out in pensions versus what we expect to take in from contributions and make in investments and things like that. And then since then, you've transitioned, in an interim capacity over to overseeing the operations in Invo. Can you just talk to us about, from that investment perspective, like what you're seeing as our top priorities, things that you're working on, challenges, things of that nature?
Sure, thanks, David. It is, to echo Marcy, great to see everyone in person and those familiar faces on Zoom as well. I think everyone knows that we have a new Chief Investment Officer, Nicole Musico, who joined us last spring. So we've really been focused on her 2 key themes of innovation and resiliency within the investment office. And that's coming off of many of you engaged in the asset liability management process that David just mentioned that we worked through in 2021. And coming out of that was really the long-term vision of the office that we're running with, which is moving more into the private markets that Nicole will talk more about in our next session, as well as starting to add leverage. But certainly in the short term, we're also looking to be more nimble and reacting to, as Marcy just mentioned, clearly things have been incredibly volatile the last 2 years. We had the fantastic double-digit returns of 2 years ago, and then the negative returns of last year. There was a really interesting fact that our research team pulled together that we were talking about yesterday, that 2022 was only the 4th year since the Great Depression that both bonds and stocks went negative. And so that just sort of highlights how unusual last year was. But despite that, we do need to be nimble and react to the difficulties of the marketplace. And one of the things to do that is we've sort of amended and improved our governance structure within the investment office so we can observe what's happening out there in the markets and adjust or not adjust as appropriate as quickly as necessary. So Nicole walked through these with the board in September, but we've really created 3 committees to provide her the best recommendations and guidance as possible and let the investment office make decisions. So we've got an operating committee, we have an underwriting committee to look at the specific deals, particularly in the private markets that we're getting into more as we go forward. And then the last one, the total fund committee, where we're able to look at sort of the overall risks that the investment office is taking. We know we have to take a lot of risks to hit that 6.8% target, but we want to do them with eyes wide open, as well as keep our eye on liquidity so that as we go into the private markets, we're well aware that we're tying up resources and we don't overcommit and are still able to provide all the payments that are necessary for the retirees in the system.
Very good, thank you. Just want to remind folks, if you have questions or comments, for those of you on the Zoom, you can either chat them into the group chat box, or you can send them to me directly if you want, David Takearts, if you don't want to air it out in front of the other 100 folks on the Zoom. We are up to 110 people on the Zoom right now, by the way, and uncounted thousands watching the webcast, no doubt. And then also for folks in the room, if you'd like to make any comments or questions or anything like that, just encourage you to come up to the mic there and we can pause throughout. We don't want to just lecture you. But we will if no one asks any questions, so it's up to you. Let's turn to our chief actuary, Scott Tarando. So talk to us about what you're seeing in sort of like the pension costs landscape right now, maybe from the employer perspective, funded status of the system and what that means for the cities, the school, the state itself. Just your perspective, Scott.
Sure. So I think we can just start out with like if the funded status. If we look at where the funded status of the system is, it's hovering right around 70% right now, and that takes into consideration
70, right?
70.
Not 7. Okay?
70.
Not 7.
70. So that's a little bit better than 7 there. It's a little bit lower since 6/30/20, just a few months ago. There's been downward pressure on returns, and that's have resulted in a slight decrease in the funded status. What we're seeing in terms of we're seeing added pressure on employer costs. We have already mentioned the downward pressure on investments. There's also added in costs due to higher inflation. Last year, inflation, I think, was somewhere around 8% for the year, and that is a bit higher than what we anticipate. And we'll see that as it factors into the costs going forward. It'll be a slight increase in contributions to make up for those increased COLAs that have to be paid out to the retirees. In addition, we see a bit more pressures on employers having to cover their payments as the economy gets a little bit tighter. We've seen a number of layoffs throughout the nation and throughout California, and this will probably add just more pressure on employers. In terms of what we do, in terms of trying to level out contributions, we do amortize gains and losses over 20 years. So when we have unexpected gains or losses, we spread those out over 20 years. This way, if we have a loss in 1 year, we may have a gain in the next year that will offset it, and we don't have to make up for it right away. And in concerning investment losses, we actually take those a bit further. During the 20-year amortization, during the first 5 years, we ramp up the payment over the first 5 years. We see a bit more volatility on the investment returns, and we use that 5-year ramp up to kind of help smooth and transition any bigger changes that occur during the changes that we see.
Very good. Okay, we have our first brave soul. Go ahead. Question in the room.
Well, not a question, but us in the back, we need y'all to speak louder, please, because we cannot always hear you. So I just wanted to make sure we said that today.
Sure.
Thank you.
Thank you. Okay, so we did have a question through the chat. Can we comment on kind of what our investment status is right now, what we're looking at? I know just a note for the folks on in the conversation, we do go on a fiscal year calendar here, so there's always this temptation to say, well, what was it for calendar year, or what was it for the last 30 days? So just want to kind of always be flagging that what matters for us is at the end of June 30th. So
Correct. However, through the first quarter of the fiscal year, our investment returns were down about 5%. So that's on top of the negative 6% that we were for the prior fiscal year. So do we? We've pretty much been flat in the second quarter. So it's certainly a challenging time, and that we know that puts strain on the employers if we end up at the end of the year with similar returns. As I mentioned, last year was certainly an anomaly from a historical perspective, but that doesn't mean we can't do better. And certainly our new governance structure is designed for the investment office to, as I mentioned, be more resilient, be more nimble, be more innovative. And so we think going forward, we've got the right structure in place to do better long term.
very good. So someone in the chat asked about the comment from the audience. Ironically, the comment from the audience was they can't hear. So you didn't miss anything there. I will say, can we make sure that that mic is looped into everything? Okay, great. Thank you. Okay. Seeing no other questions right now, let's go ahead and move forward here. So let's turn back to Marcy, our CEO, on this one. So sustainable investing, this ESG question. It seems like ESG has replaced vaccination as the most contentious word in America. So you're getting asked this all the time out there. This is something that's become a little bit of like a political battle, it seems, or a proxy for politics in a way. What's our approach to this right now? How are we handling this, and what does it mean for us in terms of being a long-term investor?
Yeah, thanks, David. And so, Lenore, can you hear me okay back there? Yeah? Okay, good. So ESG, we've always looked at ESG fairly consistently since 2014, and it's really about managing long-term risks in the portfolio. Being a long-term investor means that we need to look out 10 years, 15 years, 20 years, 50 years as we're making investments today. But we also want an ecosystem within the markets that will give us the return based on the level of risk that we're willing to take. So we do a lot of work around advocacy, advocating for strong policies, advocating for strong markets. We advocate, more recently, you'll hear us talking a lot about getting better transparency about how public companies are managing their own environmental, climate, their human capital, or even their governance structures. And so when you break down ESG, and you don't just allow it to be the next three-letter bad word, it is around managing risks related to climate. It's managing risks related to poor human capital practices. It's about managing risks related to poor governance. And so CalPERS, since 2014, again, this has been a long time in the making, we've been very consistent on that approach. And I just was on CNBC last week talking about, I think we've been excellent partners to the public companies where we're investing. Now remember, we own a very small percentage of these public companies. So if you think about the global equity of the public companies, but we have a very loud voice, but we're careful about where we use it. And so the other thing that we have really talked about is ESG is missing one of the letters, and that's an F, not to turn it into that kind of word, but it's the fiduciary standard. It's a fiduciary standard that our board has to meet. It's the fiduciary standard that I have to meet, fiduciary standard that our investors have to meet. So we're looking at it predominantly through the risks that we're taking on in our investments we're making today, but we also are beginning to see opportunities where we think we can get that return, that 6.8% or greater return. So far, that's been more in clean energy like solar and wind, but our real assets program has made investments there, and that portfolio has performed pretty well. The other thing we do is we believe in active engagement. So even though we own a very small percentage of the companies, we want to be an active owner of the company. So we're engaging. Climate Action 100 Plus is an engagement strategy where we looked at the emissions of the portfolio. Essentially, there are 100 companies that are producing the highest level of emissions. So $55 trillion, that's not just CalPERS' portfolio, because we can't do this without our partners. We're engaging with these public companies about how they're managing those risks related to Scope 1 emissions, which are the direct emissions, Scope 2 emissions in particular. And there's a lot of conversation about the value of Scope 3 emissions when we don't have a standardized way of measuring it and reporting it. We do believe it can be material under certain conditions and certain companies, and so we'll continue to engage with our partners on that. And then the integration and investment, I mentioned that is, for the first 7 years or so, we really looked at it more predominantly in that risk lens and making sure that we're managing the risks in the portfolio. But we are beginning to see those opportunities present themselves as energy transition, consumer demand is changing. Last year, 2022, was the largest sell year for electric vehicles. And I know even on our team, I think 3 of us got EVs last year. And some of that is, gas prices, increase, that drives certain consumer demand. But we want to make sure the public companies are looking at their strategies and their business plan, that they will align with us in paying our long-term pension payments, and they can be a long-term successful company.
Very good. Not seeing any questions on that yet. This is just one that just almost everyone seems to have a pretty strong opinion on one way or the other. Just kind of continuing along these themes, you're focusing there mainly on our investment strategy with sustainability. As an organization ourselves, I mean, the investments is just like one piece of it, and we've worked hard as an organization through our diversity and outreach program to develop, in our DEI program, to develop really this kind of like a focus map. Can you just talk to us about how this is being implemented and your thoughts behind this?
I think hopefully you have seen the diversity, equity, and inclusion framework that we presented out to the board. Marlene Timberlake-Diadamo is our diversity and inclusion officer. I think she's in the room. There she is. Can you stand up real quickly? So this is Marlene. And she, along with every program at CalPERS, really created this 5 ways in which we can manage diversity and inclusion within CalPERS. So we've got the way that we govern, the investments on the outside, and then we have to think about culture within CalPERS. Now, I'm a big culture person. I believe there are ways to measure culture. Usually, I always talk about the 5 ways to measure culture. The first one is around members, making sure that we're doing what we need to do to meet members' expectations and that you're satisfied with the services that you're getting. But the second one is really about the team and making sure that we are able to hire the talent that is necessary, that is reflective of the communities in which we serve, to be able to have this, this entity, CalPERS, perform what it's expected to do, deliver retirement and healthcare benefits. So we have just started on this journey. The framework is in place, and Marlene and her team, she's filling out her team. She's got a couple vacancies that she's recruiting for. If you have an interest in working in this area, reach out to her. But it's, we need to manage it on the investment side. So not only are we expecting that the companies in which we invest in think about their own C-suites, think about the type of hiring practices they have, we also need to be bringing that into CalPERS. And I know I get a lot of pushback on, what about Prop 209? And Prop 209 is our boundaries that we have to operate within. Those are constraints. There's a lot of room in the middle for us to maneuver. And when you think about the data, the research that's out there, that more diverse companies actually perform better. They produce better. And we believe that internally for CalPERS as well. So culture is important, how we manage and hire our talent. I can give you an example of that. Our recruitment announcements. One of the initiatives that we put in place was to have every recruitment announcement that goes out to advertise a CalPERS opening to be reviewed for bias in the way that that job was being explained, announced, or recruited for. And we made some changes based on some feedback that we had gotten from someone who we hired to come in and help us do that. We didn't have that expertise internally, but CalPERS can acquire that expertise. And then supplier diversity would be the same thing. Supplier diversity, sometimes it's just easy to go with the same group of suppliers that you've always had. And it does, maybe it takes a little more time to make sure that you cast that big wide net to bring everyone in. And then once people are in, then you go through the normal recruitment process or the normal selection process where bias is not included. But you need to make sure that you're patient and you're able to open up that recruitment, open up that RFP to make sure that everyone has an opportunity to come in and compete fairly. I think we have a question. And then health equity, and Dawn, I know is going to talk about that this afternoon.
Yeah, I had a question about engagement, going back to that. I wonder how CalPERS can be so wedded to this policy of engagement when it seems not to have been working. For instance, despite pledges that companies in the 100 plus have been making, they are all expanding. Exxon plans to increase production in Guyana and the Permian Basin, and Shell plans to increase liquefied natural gas volumes to deliver more than 7 million tons per annum of new capacity by 2050. And Duke Energy also promised net zero by 2050, but plans to keep coal online at least as 2048. And a study of the 10 major oil and gas companies that CalPERS is engaging with, which was done by Dr. Claire Brown, who's a professor of economics at UC Berkeley, shows that none of these companies has set the short and long-term, and medium-term rather, emission reduction goals that are needed to achieve net zero by 2050. And there have been no consequences from CalPERS and other investors. And none has fully aligned with the net zero benchmarks criteria, and there have been no consequences. And despite CalPERS' engagement focus on proxy voting, in 2022 alone, it voted against 5 of the 14 climate proposals filed by other shareholders of CalPERS' largest coal and gas holdings. And a review of the 2022 proxy season, along with past votes, shows that CalPERS usually continues to support directors regardless of a company's failure to make progress in reducing emissions. And so it seems to me it's clear that the engagement process only gives cover to the fossil fuel companies to continue to greenwash their image and continue to make empty promises while continuing to grow and to produce more and more and more and expand while the world is burning up. And is it any wonder then that an evaluation of the sustainability performance of CalPERS by the United Nations Conference on Trade and Development, GAS, ranked CalPERS 45th out of 47 of the largest pension funds? In other words, right near the bottom, almost at the bottom.
Okay, you've given us a lot to chew on here. It's going to be hard to answer because we're going through. I mean, do you want to take a?
Yeah, I can respond to your remarks. So, as I mentioned, CalPERS is a very small holder including in the energy companies or the oil and gas companies. But what we do offer is this voice that's louder than our shareholder size. But mainly we're holding these companies passively. So we're not taking an active call on this. This is passive within, the index and the associated benchmark. So ranking us 45 out of 47 when most of the other public pensions do it this exact same way we've done, other than the few states that have actually made a divestment decision. So for me, I don't believe, this is my personal opinion I'm sharing with you, but I don't think divestment works. What we do believe is that engagement and energy transition to get to 2050, it's okay, I know you're not going to agree with me, it's okay. To get to 2050 is an energy transition course. It's not a divestment course. And we have that active engagement with CEOs of these oil and gas companies, whether that's BP as an example. And, and I won't get into a lot of detail on that, but there are energy transition plans. But to do a divestment and cut off capital to companies that are trying to transition and to really do the right thing. This is not an overnight fix. It didn't take us, a year or 2 years to get to the state that we're in, but the commitment is to be net zero by 2050, as you indicate. And part of our path to get there is to continue that active engagement, use our voice where it matters, and abide by the fiduciary duty that we have to. And right now, those assets, it would not fulfill our fiduciary duty to sell off those assets.
Debatable, but while this transition, quote unquote, transition plan is happening, the gas companies are having a heyday, expanding. I gave 3 instances. The research is full of instances on how they are simply using their fake promises to expand. So I don't accept the policy.
All right, thank you. Okay. Seeing no other questions right now, and I don't see any in the chat. Again, if the folks in the Zoom want to be heard, you can raise your virtual hand and we can unmute you, or you can just chat in a question or send it to me directly, however you want to handle it. Kind of moving towards the end of our first panel here, and then we'll just open it up for more questions. Why don't we start maybe with Michael Cohen? Just looking forward, we've started 2023, and I know a lot of this we have already hit on a little bit, but just as in summary, really, what are the big things that you're focused on in your area? What are the things that you're looking to see how it develops and how it plays out? And just talk us through kind of what the stakeholder community can expect or should be looking for, at least, in the coming 11 months.
Sure. As I mentioned, one of the key pieces of our new strategic asset allocation, and this is really just to queue up our next panel, is our move into private assets. Nicole did an excellent job in the fall in walking through the board in terms of the years that we didn't put consistent investments into private assets have really cost the system billions of dollars. And so we need to rebuild our expertise in that, deploy billions of dollars into a variety of private assets, because historically, even accounting for the fees that you pay on those investments, they yield better net returns than on average than all of our other asset classes. And so we really need to do that. We need to continue to figure out how to be more nimble, evaluate what's happening in the economy, and not making a decision is a decision. So that if we choose to stay the course, we're doing it actively and going, yes, we're still comfortable with the assumptions that we made that led us down this course. So if we need to come back to the board and we will be reviewing our strategic asset allocation on a regular basis with the board, and that's part of the process to make sure that we're, in essence, kicking the tires more frequently to make sure that, yes, everything we know right now is internally consistent and makes sense for a long-term investor. But we've also positioned ourselves in the best way possible to be sustainable in the short term as well as the long term.
Good, thank you. Scott, how about you? What's on the horizon in the actuarial office?
For us in our actuarial office, we continue to work on tools to make available to employers to help them get a better understanding of where their contributions are and where they're projected to go. We have out there the Pension Outlook tool where employers can pull up their contributions and under various different investment scenarios, see where their contributions may wind up. We also have another tool out there for those employers wishing to make additional contributions. We can model those additional contributions, the impact on their amortization schedule, and make adjustments to help level out contributions over the year. Another tools that we're working on, we're just trying to get out tools for the employers to kind of see what's out there data-wise. We're working on tools for employers to make comparisons between themselves and other employers in the area in terms of contribution rates, funded status. And generally, we're going out there and talking to employers and seeing if they're having issues with contributions, and if we can help them in any way kind of level out their contributions to the system and any worries they might be having or difficulties in making those payments to CalPERS.
Scott, was there anything that came out of the budget for the state that would be relevant for the stakeholders to know about in terms of money set aside for the state to pay down its unfunded liabilities, or where are we in that conversation?
I'm not aware anything was set aside in the budget this year.
All right, can someone go talk to their legislators, please?
Yeah, well, I think, from what we're seeing in the papers, the state's running a deficit this year. So I do know they tend every year to try and make additional contributions, both on the state side and on the school side when available. But I haven't seen anything yet so far for additional contributions.
Okay, great. And Marcy, why don't we turn to you now? So yeah, same basic question. What's the general outlook for 2023? What are you focused on? What are you hoping to accomplish? Or what should the community be kind of keyed in on?
I think more communication. And again, this is another area I'd like to get a little more insight on, because we get a lot of feedback that we're not transparent enough in how we're making decisions. And so transparency means a lot of different things to different people. So we'd really love to get more feedback and more specific feedback on how we could do better there. We do engage with a benchmarking company out of Toronto, Canada, called CEM, and we have a transparency benchmark where CalPERS has performed very well there relative to its peers. But when you bring that a little more locally, transparency, again, is defined differently by different stakeholders. So love to hear a little more there. We have John Myers. I don't think John's in here, but John Myers is now a part of our team as well, and this is a question that he keeps asking me too. I think the other is, because the investment portfolio and just really trying to find ways to get those excess returns, I think this will be a nice tee up for Nicole and Anton to be able to talk about their viewpoint on this and the strategy moving forward, how they're implementing the strategic asset allocation, that was approved by the board back in November of 21. But Michael's right, there will be more in alternatives, more in private markets, and sometimes that causes a little bit of concern because private markets and the decisions sometimes around those deals does happen within closed session with the board, because that's their fiduciary duty to make sure that they're overseeing the investment function. But some of that data is not available to you until after the deal has closed. So just want to let you know, anytime we improve that or increase that asset allocation on the private side, there will be more opportunities for the board in closed session to weigh in more directly with Nicole and team. And then, this mounting pressure on not just divestment, but just an anti-ESG rhetoric. I'll be out there probably most of next year interacting with a variety of stakeholders about the way CalPERS has seen it, a very consistent approach. I don't see our approach changing unless we see more investment opportunities to really put our money to work for all of you. But I think that's it for me.
Great, thank you. And just kind of our last slide here, just want to throw up, resonating back on that communications one. We really try hard to be as available as possible, whether it's at a lower level like me or Marcy herself getting out there and speaking, and everything in between, at whether it's conferences or at city council meetings or member meetings of any size or shape. We try to be out there to be sharing the message about what's going on. And it's one message really to all stakeholders. I mean, there is no side to it from our perspective at CalPERS. It's just like, what is going on with the markets? What are we hearing from the legislature? What are the policies that we're putting in place? The costs, and what are the options that the various stakeholders have? So we want to get out there and clear the air for anybody. So you can always reach out to us. I'll just ask my team to type in our sort of catch-all email box for this. It's CalPERS_stakeholder_relations, and we can work to get either information or human beings to you, promptly. We've got a couple of those in the hopper right now, and Marcy is speaking at the end of next week to a large group of finance officers at a big conference. Michael Cohen is leaving literally 5 minutes after this panel ends to go speak at a conference across town. So, I mean, the top leadership is out there, and we're trying to get that information. I also just want to take this one moment here, back to that email box I mentioned. I am looking for volunteers for sort of like a focus group right now to talk about retirement security and what the stakeholder community would need to see or hear in order to kind of increase overall confidence in retirement security. Remember, this came from our conversation at the board offsite. So if you're interested in being part of sort of an objective focus group, it won't be me, you won't be hurting my feelings. Someone will lead this. Just want to hear your thoughts in this space so we can bring back some qualitative data to the board at our July offsite. So please email me if you're interested in being part of that. Okay, so we've reached the end of our sort of prepared remarks. So I want to open up again for any questions or comments. See someone in the room. Again, folks on the Zoom, we'd be happy to hear from you too. So, sir, go ahead.
Touch on the communication. You said that you want more communication, but we had members from local 521 at SEIU reach out about when you asked for suggestions about speaking to equity and diversity, and you did, but that member never got a response back, so it was believed that you guys weren't going to touch on it today. And so it just really takes away a lot of the enthusiasm to be engaged in these group conversations when they don't get a response back. And you talk about you're reaching out to groups and these other people, but the members are the people that are really supporting all this, and they don't feel like they're being communicated to directly or even being kind of, yeah, we hear what you're saying, and then you just touch on it, but they're never told that you are going to touch on it.
Okay. Well, I appreciate that input, and I oversee that group, and so we'll do better in that space. Thank you. Appreciate that. Okay. Question came in from the chat. Back to the kind of like fossil fuel issue. Have we seen, like, in terms of just raw profitability, has it been a successful asset class for us lately?
Well, it can be very volatile, like many of our public companies during different market cycles. You saw gas prices increase. Our own employees were very concerned about the cost of commuting, and so the companies were quite profitable during that period of time. And then you go through market cycles where they're not. And so, again, we're diversified in our portfolio. Each of these assets is going to perform differently under different cycles, and historically they have performed pretty well.
Very good. Just got some clarification from a team member that, yeah, there is some discussion of, the budget does include a $1.2 billion one-time Prop 2 debt repayment for the state plan. So at least for now, it's being discussed at least. Hopefully that comes through. But with the deficit, it may be on the chopping block. Hopefully not. Another comment or question in the room? Go ahead.
This is probably a question for Scott, but have there been any discussions about changing any assumptions related to just inflation? We're seeing so much upward pressure on wages, and I didn't know if there were discussions about changes there that we should be planning for.
Right now, we're not looking on changing inflation. We generally look at changing our assumptions every 4 years. We do take we are watching it though. If we crank up the inflation rate, your rates are going to go up even more. So we're, we want to be cautious that if inflation starts to come down, we don't want to kind of like raise the long-term inflation and then bring it down and have your rates kind of be a roller coaster. We want to take a longer-term view on inflation, but if inflation continues to be higher than what we expect, if the Fed raises its long-term outlook on inflation, right now they're still sticking with 2%. If they come out and they take raise their expectations, then we'll look at raising the inflation rate. We want to be careful on that because you will have short-term losses with inflation right now, and that'll work towards a little bit higher rates. But if we were to increase the inflation on a long-term basis, it'd have a larger impact on your contributions, and we want to be careful with that.
Thank you. From an employer perspective, that's great to hear.
Sure.
Thanks, Scott. All right, let's get adventurous here. Let's try to take a Zoom question audibly. All right, Jerry Fontaine, you are up. Go ahead and unmute and fire away.
Okay, can you hear me well? Okay. There's a concern with investments that there's more energy put forward to how CalPERS stands in the world as far as a proponent for environmental issues and less on investments to support our retirement fund. We see other organizations make better returns in their investments, and there's a thought that CalPERS needs to realign their responsibilities towards its members and less towards environmental issues. We've seen tremendous losses in divestments in the past. Yes, we probably have made that up, but if we wouldn't have gone down the road of divestments, we would be farther ahead. So I feel that CalPERS needs to rethink their priorities. Thank you.
Thank you, Jerry. Okay, next question also from the Zoom. I have one from Michelle Dennis. Michelle, go ahead and unmute and ask away or comment. Go ahead.
Good morning, everybody. I'm a former finance director for the city of Santa Monica, and I teach public budgeting and finance at the Luskin Graduate School of Public Affairs at UCLA. Cities are right now preparing their fiscals 23, 24, and possibly 24, 25 budgets. What is the direction and magnitude of employer contribution rates that should be considered in their budget processes? Can you comment about that?
For the rates for your
on average, I realize that it could
on average,
yeah.
I think if you go back and you there's two ways of looking at it. You can use Pension Outlook to make specific estimates on your impact on your contributions, but I think if you go back, we presented a presentation to the Finance and Admin Committee, I think it was in September, where we talked about an impact of what's a 1% loss of investments or a 1% gain on investments on contribution rates. And what we found is generally for a 1% change in investment return, it equated to around a 1% change in contribution rates for miscellaneous and around the 1.5% change for safety plans. So if
if the current fiscal, so if the last year went down, your return was down 6%, then that they should assume approximately on the average of an increased contribution of 6%.
Yeah, or 6 to 8% depending on the plan. Now, actually, when you think about it, we lost. That's not a negative 6%. In terms of a loss, we expected, remember, around 6.8. So you're talking around 14% overall loss. The 6.8 to 0 is 6.8, and then you add the additional negative 6 on that, you're looking at negative 13, negative 14% loss on return. So for plans, you're looking well over a 10% increase after the 5-year phase in. After we ramp up over 5 years, it's a substantial loss on the plans.
Yeah,
but if you go back and you remember the previous year, we had over a 20% gain. So if you kind of look at what's happening with the rates is, if you go back 2 years ago before, if you look at what the rates were before we had that the 20% return, you're going to see rates comparable to that. What's going to happen is rates are going to drop due to the 20% return, and then they're going to come back up to pretty much where they were before, because those 2 years balance those 2 years in return wise are pretty much counteract one another.
Great. Thanks, Scott. Professor Gerling, I am seeing your question in the chat about percentage of the PERF in alternative energy assets versus fossil fuels. Don't have that handy right here, but we will research that, and I'll get that back to you as soon as I can. Scott, probably a relatively easy one for you, and then we're kind of coming to the end of our little panel here. So if employers increase wages for employees, more than CalPERS assumes, will that increase our unfunded liability?
Yes, it will. Yes, simple answer, yes.
Yep. Yeah, that's part of that sort of like the actuarial assumptions, demographics piece, that half or less than half of the equation for what how rates are calculated.
Yeah, and what happens is it'll affect you both ways. Your normal costs will go up because your normal cost is a percent of pay. So as your pay goes up, you'll be paying more dollars. The percent will stay the same, but the dollars will increase. But what will happen is you're going to have a gain in terms of your salary increases will exceed our expectations. And so there'll be an increase in your liabilities, and we'll just factor it in as a loss and amortized over 20 years.
Yeah. Okay, last question here from a familiar name, Sarah Lamnin. Good to hear from you. Go ahead and unmute and fire away.
Thank you. Probably won't be a surprise what I'm going to say, but good morning, everybody. Just wanted to push back gently and respectfully on the comment about looking back to that 20-year return year, because that was really 1 year after many years of loss, and now we're looking at loss again. And even in that good year, employer rates went up again. And so, as we look at these investment issues, we really need to look at the cost issues, because the equation for employers hasn't changed, and in fact continues to get worse. And so the lens of look back at the long range really isn't serving us well from a sustainability standpoint. Again, I know this is not new information, but I appreciate the continued work to try and change this equation, because it's not sustainable as it is now. Thanks.
Thank you, Sarah. Okay, so that's going to wrap up our informal piece of this segment. Now, let's all enter a public meeting and have an opportunity for public comment. So, does anyone in the room wish to offer public comment? If so, you can come forward. You would have your regular 3 minutes if you'd like to be heard. Going once, going twice. Okay, anyone on the Zoom, if you would like to offer official public comment, go ahead and raise your e-hand. Not seeing any. I do not. Okay, my screen is in a different format somehow. Look, it's not. Okay, well, I'm going to use that screen. So, Christina Baruman, go ahead. If you would like to offer public comment, go ahead and unmute. Yeah, I'm not hearing you. I'll try to unmute you on my end now.
Oh, hello?
Yes, we can hear you. Go ahead.
Oh, I'm very sorry. I wasn't going to make a public comment. I do appreciate being able to be here today, but something's wrong with my screen and it keeps flashing, and I think I clicked on the wrong item. Sorry.
Okay. No problem, but we are going to enter that into the public record.
Okay, thank you.
All right. Thank you. So that's going to wrap up our first panel. Oh, wait, nope. There's a third mode. I forgot. Tricky. Okay, so if anyone on the phone would like to offer public comment. Mr. Kelly, do we have any callers? No. We're just bridging between communication channels here. All right. So that will conclude our first segment. We're going to take a short 5-minute break as we sort of reconfigure and get our next panelist mic'd up. Please go ahead and stretch your legs. We still have some coffee out there in the lobby area if you'd like. And folks on the Zoom, we'll start back at 11:05. 11:05. Thank you. All right, we are back. Thank you, everyone. We got folks retaking their seats. And again, welcome to everybody joining us via our Zoom. Everyone's been doing very good at muting themselves. Appreciate that. Welcome also to those of you watching via webcast right now. We're moving on to segment 2 of our 4th annual Stakeholder Forum. The title of this segment is Beyond 60/40, Private Assets and Innovative Investment Strategies. And joining me will be Nicole Musico, our Chief Investment Officer, and Anton Orlik, who will either be a new name or a vaguely familiar one to you because he has worked at CalPERS before, and he's our Managing Investment Director over private equity. So that's going to be our main focus here in terms of our initial conversation. And then as we get to the tail end, we'll also carve out time for any sort of like open-ended investment-related questions. But to start off with, let's just do a little bit of introductions. Nicole, you've been here for, what, like 6 months, 7 months? Not that long?
9 months.
9 months. Wow. Okay. So if you could just tell the stakeholders and newer board members as well, just a little bit of your background, how you came to be in this role now.
Yeah, absolutely. Thank you so much, first off. I was really looking forward to today having the opportunity to speak to our members. I did start, it's almost 10 months. I actually started at the end of March. My son and I moved out to Sacramento. I'd never been to Sacramento before I joined CalPERS. And it's been a very incredible start. Everyone's very warm. And in particular, I've been super supported by the team and staff at CalPERS. So my background, I spent 20 years. That makes me feel old saying that, but I spent 20 years in private equity prior to joining CalPERS. I spent much of that career in some of the Canadian institutions, 16 years at Ontario Teachers. And Ontario Teachers is a pension plan that was really one of the first to get really involved in direct investing. And we're going to talk a lot about private equity today, but direct investing, whether through private equity, infrastructure, real estate, et cetera. So great deal of my career was spent in private markets within an institution, and then I had a stint at my own private equity firm based out of New York before joining here last March.
Great. Well, welcome. And I cannot believe it's been 10 months.
I know.
Okay, Anton, same question to you. Can you give us a little bit of your background and what brought you back to CalPERS? Mike's not on. Bottom there. Flick it to the right. Yeah.
Hello?
There we go.
Okay. I've returned to CalPERS. I was here from about 2013 to 2016. Been in my new seat for about 3.5 months. And in between, I worked in private equity at a family office. And I was also on a deployment with the Navy in Afghanistan, and most recently was at Kaiser Permanente as head of alternative investments. And there I invested 4 vintage years and sat in that seat right before joining. Heavy emphasis on private equity, which ties obviously to my role here, and I'm very happy to be back.
Great, well, welcome. And can you just tell us a little bit about your time at Kaiser? I was surprised to hear at how enormous their retirement plan is. I just did not understand the scope of Kaiser.
Yeah, it was a good experience to come back to CalPERS with. It has about $120 billion of retirement assets, and the vast majority of that is a defined benefit plan. So a lot of similarities to the investments here. A little bit different because it's an ERISA capital pool, but the public scrutiny of that, I think, does have lessons to bear here. And then there are about $50 billion of balance sheet assets that are also invested, so $160 billion or so in total. The proportion to alternative investments is over 50%, about 50 to 55%. So the dollars at work is very similar to what's here at CalPERS. So smaller pool, higher percentage versus CalPERS' larger pool and smaller percentage.
Okay, yeah. I just did not know that Kaiser had a pension plan for one thing. I mean, it's no CalPERS, okay? It's no $450 billion, but still big. Okay, so let's dive into our material here. First off, so our title here is Beyond 60/40. What we're saying there is the traditional kind of way that a lot of us, if you're managing your own portfolio or just like the kind of basic, sliced white bread approach is 60% stocks, 40% bonds, and that should, get you pretty balanced out. I guess sort of our thesis here is that that truism no longer holds. And so I'm just maybe turning to Anton. Can you just kind of define for us what we're talking about when we're saying, private equity, the private markets? Can you just delineate that from how that is different from the 60-40, and just maybe start us off at the bottom with a little bit of intro, and then tell us why you think it's meaningful and important for our portfolio here at CalPERS.
So at its most basic level, essentially assets that are not publicly traded or marketable is the term that's often used. So if you think about the stock market, you can invest in an index, you can go on your brokerage account, buy and sell stocks. You would not be able to access, for the most part, private investments. The privates are not limited to equities. They pretty much have their equivalents in all the asset classes, so you can buy bonds in your retirement account, et cetera. So we would have an equivalent private debt asset class. And I think the key point is you're capturing what's called the illiquidity premium, and also you're avoiding the short-term nature of public markets and have the opportunity to take a long-term perspective on the investments, which can generate higher returns.
So, John Q. investor like me, what access would I have to private assets if I were trying to invest in that? Is there a way at all, or is it really by being part of a defined benefit plan like this that's how the average investor has access?
As of this point, the average investor does not have access. There are increasingly channels for high net worth individuals, but even those are not the same scope and depth of access that you have through the defined benefit plan at CalPERS.
Yeah. Okay, very good. Having some trouble with our stuff here. So talking about the advantages of the private markets, just got some of the main key points here. Can you just express your philosophy on this a little bit? Just get into a little bit more detail on why you think the private equity sphere is important for CalPERS and why we're looking to commit more and more capital to this.
So the key point is the higher returns for the same risk. Essentially, you're engaging the same sort of equity risk. You do take on illiquidity risk, so that's the inability to quickly monetize your asset. But that illiquidity premium is something that really works well for a long-term investor like CalPERS. Another point is there's a higher amount of what they call return dispersion. So the distance between the lowest and highest returning asset manager in private equity is much larger than in public equity management. As a result, there's the opportunity to outperform if one can consistently invest in above average managers. Those two things together do make the asset class a strong, return opportunity for the pensioners.
Why do you think that is? Why is there such a high dispersion in this asset versus managers of public stocks? I mean, I've heard it. It's sort of like there's a limited number of like top tier players. What is it there? Are these folks having just a better read on the market? Is it their contacts? Is it their deal flow? What is that, in your opinion?
Yeah, there's a lot of academic literature on this. But one point, independent of skill, is the fact that investors essentially are getting higher returns for locking up their capital. So we shouldn't forget that component of it. And then the space does attract a lot of talent. There are compensation structures combined with control over the companies that allow the investment professionals to essentially manifest their strategies in a way that's isolated from the noise of the market. And that's what generates outsized returns. But there are some people who don't exercise that control well and generate below average returns.
Interesting. Nicole?
I'd say that manager selection piece is, it is everything. It's key because it's not an easy business. Having been in both seats as a LP and as a GP, there's an entire toolkit that one of those top performing managers has at the end of the day that is very differentiated than the lower performing. So what do I mean by that? Oftentimes some of the consistent things we would be looking for when we're seeking out these top tier managers is everything from true deep sector expertise. So actually really understanding how to make money in the sectors they're investing in. But it goes even, way, way beyond that. It's their ability to attract and retain talent, to create a culture of people wanting to work hard, similar value base at their firm. It's about having, a global mindset. It's about having the ability to bring in diversity of thought, et cetera. And so when we do our diligence to seek out these top managers, there is a lot involved there. There's a lot of, rocks we're turning, if you will, to make sure that they're more than just throwing their capital at opportunities because a business is for sale. There's a real skill involved there. And so that's why the diligence process and the operational diligence that's involved in every single one of these investments that we're making into partners is really what differentiates the good from the bad.
Maybe it's a little bit kind of out of order on our slides, but let's just do it. So I know that we've recently announced a new kind of initiative through 2 external partnerships that's looking to sort of tap into maybe that next wave of talent, because you're saying like there are sort of like established players that have not a corner on the market, but they have a lion's share of it. Was that part of our reasoning behind the allocations to TPG and Grosvenor?
Yeah, we could have a whole session on what we think were the secret sauces in that strategy. Look, that's a strategy from 30,000 feet up. That's a strategy that basically says large institutions like us today tend to invest our capital in these large asset gatherers. The private equity industry overall has really evolved. So it went from being small individual funds that at any point in time could raise $1 billion to we see in the press all the time now groups that are able to raise 10, 15, 20 billion dollars at a time. You got to find a lot of opportunities to be able to deploy that, and you can imagine how there could be a diminish of returns over time. And so the thesis here is that there just aren't a lot of institutions like us that are spending the time, putting the resources to work, whether through partners or on our own, to engage in that slipstream of opportunity. And so that's point one. It's kind of capturing a part of the market where no one else is. The second piece is, think about if you're on your fifth, you've done it for the 5th time, so to speak, versus being a younger, hungry, out to prove something. There's actually a lot of empirical evidence that can demonstrate that emerging managers can outperform their peers. And a lot of it just has to do with the human nature of the hustle, the grind, getting out there and wanting to demonstrate to their shareholders as fiduciaries that you've chosen the right group to back for years to come. And so there's 2 pieces of that. For us, the third really important piece for us was that a lot of these emerging managers tend to be led by diverse entrepreneurs. And so capturing that diversity, knowing that we are going after a part of the ecosystem that has proven that it can generate outsized returns was really a double win for us. Yeah. So we think about it as a diversity play within emerging managers, and we're super excited about it.
Yeah, that is cool. Anton.
Yeah, just to elaborate on the point about the importance of manager selection, and it is a complex set of considerations, right? We're looking at the individuals, the firms they're with, where those firms are on their life cycles, the types of companies they're investing in. All those things come together to create this return dispersion, make manager selection critical. And to put some numbers on it, directionally, these numbers are about right. If you take the 50th percentile for a public equity manager versus the 25th percentile, the difference is about 2% in performance per year. For private equity, it's about 10%. And so you can just think about your own portfolios, about how much opportunity there is in capturing that manager skill through our own selection.
Yeah, that is remarkable. So that could turn into, after that sort of difference in outcome, I mean, you're starting to talk about multiple billions. That's some real money after a while. So, I mean, what is the competition like to get the dry powder allocated into these funds? Are we, like, in your opinion, what is the secret sauce for us to be the ones that get that money allocated and in play, and then to reap those returns?
I'd say our portfolio has two major buckets along this lines. The first is the really established managers that are performing very well. There's a concept in the academic literature called performance persistence. And it basically says if you did well in your current fund, you're more likely to do well in your next fund. And so with those managers who are well known, that portion of the portfolio is really about obtaining access. They're oversubscribed, and we're working diligently to get allocations relative to other pension plans, endowments, foundations, the full set of institutional investors. The second bucket is much more around finding the future winners, and that requires more skill on our part. And there's more dispersion there than there is even with the established managers.
The only thing I'd add is it's as far as being chosen, one of the lucky chosen ones for these oversubscribed funds, or even having the ability to spend time with the up and coming managers, it's really about us establishing our reputation in the market for being a good partner. And so what does a good partner mean? It's everything from being agile with, our ability to give and receive information. It's about building up trust and relationship over time. It's about having the same kind of vision for what the long-term outlook for the thematics that they're investing in, and demonstrating that we have knowledge, we're excited. And for us, it's, building those relationships is just so key, because this is an expensive asset class. Like, we pay big fees in this asset class, and the way that we offset those fees, and we're happy to pay the fees because of the performance. And so net, we're still way ahead if we pick the managers right. But we've been spending a great deal of time as the industry has evolved. The large institutions spend time on co-investing, and co-investing is really where you have a deal that's been executed through a fund, but they need more capital. So they come to the pensions, or they come to the other limited partners and say, we need more capital. Are you available to participate? And from our perspective, we'd say, in most cases, the vast majority of cases, we'd say, sure, but we don't want to have to pay fees on that. And that allows us to average down, because we're showing up with the capital. We're showing our agility. We're showing our smarts. We're showing we can be great partners. And for that, there's a cost. The cost is we are not going to pay the same fees that we otherwise are paying you in our fund investment. And so there's a real opportunity
how do they respond
to
to that?
Listen, if we are bringing the capital to help them transact on a deal, we show that we are trustworthy, good transparency, have agile processes, can get to a yes, or frankly, in some cases, get to a no, they appreciate that as well, then we're deemed good partners, and it's a win-win for everybody.
Interesting. Very good. Thank you. I did see a raised hand on the folks in the Zoom. Not sure. We're having a little bit of discrepancies here where I'm seeing some hands, some not. Suzanne on the Zoom, did you have a question that you wanted to voice? No, I'm seeing a shaking head. Okay. If you could try to lower, on my end, I can see a raised yellow hand. If you could lower that, if possible. All right, thank you. Okay, so let's continue on then. Again, just like our last segment, if folks have questions or comments interspersed throughout, we'll be happy to take those. Or you can shoot me a chat on the Zoom. So Anton, as the MID, our Managing Investment Director over private equity, can you just outline for us our kind of your strategic priorities right now? Just walk us through what we're looking at and some of the challenges, just things you think the stakeholder community would appreciate knowing.
Yeah, so I'll walk through these circles, starting at the top. Deployment at scale is an important concept, right? So if I can generate very high returns with a very small amount of capital, that's not really useful to the pension. It's not going to provide the benefits that we need. Now, what we try to do is look for opportunities where that scale is an advantage. And so essentially turning a disadvantage into an advantage. On average, it's probably harder to deploy at scale, but there are pockets where we can get paid for being larger. Now, of course, we want to build a diversified portfolio. Diversification is key to being able to weather different economic environments, and you can essentially enhance your returns without taking higher risk through diversification.
Anton, when we say diversification in this context, are we talking about a variety of managers, or are we talking about those managers investing across a variety of industries or segments, or is it both?
It's all those things.
Okay.
So I think, specifically within the context of private equity, we're not talking about asset class diversification, but that's probably the single most important one. And so, we have a fixed income, private debt, private equity, et cetera. But there's also diversification within the private equity asset class, and that is from the life cycle of the companies, venture versus growth versus buyout, the industries in which they participate, the size of the companies in which they invest. All those things contribute to diversification. Thanks for the clarification question. And then moving to the other items on the slide. So cost effectiveness is crucial because it is a high cost asset class. So insofar as we can get access to the same quality of opportunities, say through co-investment, where we're getting exposure to the same companies that are in the funds in which we're invested at no fee, no carry terms, we are essentially reducing our what they call gross to net spread. We're getting higher net returns. Same gross returns, we're just reducing the costs. And all these things, manager selection, being more cost effective in deployment, getting more credit for being larger, those all help us outperform the benchmark. And then moving to the final circle, I think the key point there is we want to have a portfolio that's resilient. This is a key theme from the Chief Investment Officer. The resiliency means being able to survive different economic regimes, being able to generate returns in a way that's not limited on a bubble, not limited to a particular strategy, which has what we would call negative externalities that are corrosive to the broader market.
Well put. So Nicole, we've heard now about the overall priorities. Another piece of this, as we heard in the previous segment with our CEO, Marcy, talking about the importance of ESG in the conversation broadly in the CalPERS universe right now, and how important it is for us to use this as a risk lens through which we view investments. I think for most people, they're thinking about, our public markets there and like the sort of publicized proxy access and things like that. But from the private space, this is also a priority of ours. Can you just talk us through how you view this and some priorities of the shop right now?
Sure, no, my pleasure. So we've touched on a few times that I've been using these two themes of innovation and resiliency, and I'd say this topic is a perfect area to kind of think about both the resiliency lens as well as the innovation lens. So the resiliency lens is a lot of what we are talking about today. Do we know what we own? Do we understand the risks within our portfolio related to ESG issues? Are we engaging with our private companies? Are we making sure that we have appropriate frameworks in place before we make the investment? And are we working with our partners to stay in touch with them to make sure they're evolving their own practices? And ESG, as Marcy touched on in her conversations, certainly it's about energy transformation, transition, but it's also about the S, the social bits, as well as G, the governance bits. And so the private equity programs, again, across private equity, infrastructure, and real estate, there's a ton of opportunity for us to be using, our longstanding tradition of being real thought leaders on how to move the needle and how to engage. So the engagement bit is super important. And again, it's everything to do with the E that we've already discussed under the energy banner. And it's everything to do with both the risk lens, but as well the innovation lens. And so right now we're moving into an era where when we think about sustainable investing, we too want to participate in these investment trends that are going to help us move through this energy transition phase, move to the 2050 goals, et cetera. And so there are a number of investable themes that we are working with our partners on. From a inside the house perspective, we've announced that we'll be bringing on a managing investment director of sustainable investing. And the idea is to make sure that we're taking both that risk, aka resiliency, as well as investing, aka innovation lens, and applying it across our programs within private markets. we have a few projects that have been ongoing that haven't specifically been related to investing, but absolutely have been related to innovation. They've been innovative and also built for resiliency. And that would be around things like our data convergence exercise, where we've gone out to 200 plus of our GPs and said, let's get some standardization going. Let's get you guys reporting in a standardized way on these metrics that really help move the needle in a sustainable investing manner across the industry. And that was an initiative that CalPERS has been spearheading with one of our investment partners. We also spent a lot of time on human capital management and working with our partners on initiatives to make sure that we are, again, thinking through the S and the G of ESG to ensure that there's appropriate human capital management occurring within our programs. And there are a number of other initiatives that we've been spearheading and thinking about not only our private equity program that Anton oversees, but also our real assets program. Everything from having our our investments make sure their vendors are being held to certain standards, reporting on that, et cetera.
Very good. Yeah, a flurry of activity going on in the investment office right now. You've done a lot in your nearly 10 months here in challenging markets for sure. So a question in the chat, can you give some examples of investment in ESG related, basically, I'll just read it verbatim. Can you give some examples / percentage of investment in ESGs in relation to percentage of investment in fossil fuels? Is there an overlap in the private markets with the fossil fuels? Is that a big piece of it?
In the private markets area, I'd say our focus is more on renewable energy. Okay. And so I think that would be an area when we think through both the opportunity or innovation lens as well as the resiliency lens. We're trying to think about where are we trying to bring the program going forward. And so from an investable theme perspective, we'll be leaning more into renewable energy transition with our partners over time.
Okay. Now that I've kind of parsed this question a little bit, I think the embedded question is, do we sort of put any private assets in what you could call like an ESG bucket? Do we say this is an ESG approved investment, or is that not the lens through which we view and speak about this?
Yeah, no, we haven't segmented our program to say, okay, we're going to reserve some capital for just ESG related themes. We're really trying to use a framework for sustainable investing across the board. Mm-hmm. We just think it's fundamentally our role to make sure that we're sustainable investors. And so during diligence, during the ownership period, during those partnerships, whether that's fund investing or looking at co-investments, we're holding ourselves accountable to make sure that we're being held accountable as well as our partners being held accountable to be measuring and tracking the progress that we're being made. And that's why we kicked off the ESG data convergence program, within the last year and a half, call it, and why we're bringing on a managing investment director of sustainability so that we can get an umbrella kind of approach, if you will, across investments to make sure that we're holding our end of what we've committed to, which is make sure we're sustainable investors. Yeah.
That data convergence one is, I just think, so important. I mean, just being able, because the flip side of the private markets is that, yes, they have the potential to be more lucrative, but by their very nature, you just don't have as much access to the particular data sets. And so if we can get agreement from the various partners and managers on, okay, these are the 15 columns we want to see on this spreadsheet, okay? Not 27 over here, not 700 over here, not 0 on this one. If we can get agreement on what are the data sets in the fields, then you can have real meaningful information, and then we could, basically policy can spring from that. So I just think that's very laudable.
Yeah, I mean, just think about the flywheel effect, if I can use that term, on this exercise. So not only are we engaging by asking the question of our partners, these general partners who we deploy capital with have invested in thousands of businesses that they then are having to go out to in order to perform the exercise of us requesting their data. And so thousands of businesses have been engaged with because the general partners, the 200 plus general partners that have signed up for this very important initiative have to go out to every single one of their portfolio companies, which means every single one of those portfolio companies then have to say, oh, shoot, if we didn't already have a policy in place, sounds like we need one because the people that fund us are asking for it. And so there's so many intangible, like I can't even measure the benefit that the flywheel effect that just this one initiative has had. And we've done that, just in the last year and a half, and we're just getting started.
Yeah, that's great. I mean, that's really moving the needle on an industry as a whole. I mean, that is the cool part, I think, about CalPERS as being such a large and impactful investor, is that really like initiatives that you all spearhead really have these sort of like knock-on effects throughout the industry about companies that, they're not even directly involved with us, but they get touched by these initiatives, and it really changes the market for the better.
And that's the engagement bit, right?
Yeah.
That's what Marcy has been leaning into forever now, saying like engagement comes in all shapes and sizes. Like you can see the headlines where we engage and the progress made, and we can speak to specific companies where engagement has worked, and we've got there's lots of data to support that engagement works in a very visible public way. But we're talking about touch points of thousands of companies, just making sure that they have a policy in place. If we didn't engage, none of that would be happening.
Yeah.
And that's why we're such firm believers in engagement of all levels.
It starts to have that quantum effect, right? Just simply by measuring it, you enact change.
By setting the expectation that the data is going to be collected, it sets off a whole string of activities.
Exactly. Okay, good thought-provoking question here. It came through the chat from Robert Gerling. So, given that this is a great question to ask the private equity managers, do you want more money? Do you want a bigger share of the assets? Given that private equity earns superior returns to public equity, is there any reason why it would not be advantageous to divest in publicly traded fossil fuel companies and reinvest that capital in private equity? You want more money or not, Anton?
Yeah, there's a lot to unpackage in that question. I think that, look, I can speak through my lens, and my focus has been on renewable energies within privates. And I make that decision as an investor as well, right? So you asked about Kaiser. So at Kaiser, we were what we called an ERISA pool. We were obligated to put returns first. We made the decision in 2019 when I joined to no longer make private investments in fossil fuels. And the rationale was that we would get better returns by avoiding an industry that was in secular decline. Now, I do think, though, we intellectually should distinguish between public and private investment, and then between renewables and traditional fuel or energy, because you can invest in both in either public or private markets. And so we need to, as we work through our investment framework, tease out the different decisions we're making.
Interesting. Nicole, do you have any thoughts on that?
Yeah, I think it goes back to, on the public side, we will continue to engage. When I joined, I had an eye-popping number. I asked the question, when we speak about being fiduciaries, as the new CIO, I'd love to understand, like, just order of magnitude, what would it mean if we sold off all of our, energy-related assets tomorrow? And I think the number was like 160 billion of the 450. I wouldn't feel great delivering to my members that for the purpose of feeling good about not engaging, but instead divesting, that we would be willing to forego 160 billion of assets. And so, again, we have to put this all into context. And so on the public side, we will continue to engage because we see the traction and we think it's the right way to work. On the private side, as I said, we have the opportunity to pick and choose where we're going to spend our time and where we think the needle is going to be moved most, both through a sustainable investing lens, but through a return on risk and generating returns. And so in that space, that's why we're focusing most on the renewable energy side of things.
Very good. So growth and innovation as sort of like two of our big watchwords: resiliency, innovation. Do you have? Sorry, I'll keep this closer. Beyond what we've talked about so far, are there any asset classes, in the right word, but are there any sectors that you're particularly interested in or that we are seeing as sort of emergent areas of potential profitability. One question or one suggestion maybe kind of came in through the chat. Is there anything around affordable housing? Is there anything around housing in California or in America that could be potentially something like that? Or, switching gears, is there a technology space that you're pretty hot on, or is that not quite the way that we think about it? You can just walk us through the decision-making matrix for allocations in your mind.
Sure. Maybe rather than leaning into a thematic, because we don't want to give away all of our secret sauce of where we're spending our time and attention, but I can touch on a few themes in a moment. But again, starting from 30,000 feet, the idea here is it's really to tackle a problem that most large institutions have, which is we have strategic asset allocation buckets. We have very specific approaches and bands with which and percentages with which we can invest. And within each of those investment departments, we kind of have quite prescriptive policies around where and how to deploy that capital. Now, in order for us to hit our 6.8 or 7% return ambitions and commitment, we have to find ways to be a little more creative than that. And what I mean by that is where you often will see the most interesting through a risk-reward lens opportunities arise is when they're not super plain vanilla, when they don't fit super neatly in any one grouping or bucket. Because if it's that plain vanilla, it probably means it's overshopped by every other institution. And so the idea of having an innovation bucket or a growth and innovation bucket is a fewfold. Number one, it's to give us the governance, to give us an internal appropriate process in place to look for or be responsive to ideas that don't fit neatly in any one asset class. And so you could see a scenario where, maybe it's a combination of it's kind of real estate-ish, it's kind of infrastructure-ish. Maybe that's a housing example where you've got real estate, you've got infrastructure. And for something like that to come in today, it wouldn't necessarily fit perfectly within how we benchmark or think about our role for real estate, nor would it necessarily fit within infrastructure. And so historically, those types of ideas are just sent on their way. And so it's about providing, a space, a home, an approach to investing in off the run or not fitting neatly in an asset class. The other area, kind of on a similar vein, is for new emerging disruptive technology investing. Again, today, it's difficult for us to find a right home for that because those are riskier and could overwhelm, if you will, any one given program today. If we were to identify a theme we thought, that we really believed in, we thought that it had 10, 20, because we're long-term patient investors here. So we need to have the flexibility to look at these emerging technologies or things that we think are going to be disruptive going forward. And so if those opportunities came in today of size, because we talked about the importance of scale on a 450 billion plus pool of capital, we just wouldn't have a home for those. And so again, we wanted to make sure that we prudently are looking at every opportunity that we think could create value for our members, but make sure that we're not overwhelming or disrupting the apple cart, if you will, of how our strategic asset allocation works today. And so it's multifold. The last thing I would just say is, as a CIO, it's so important to build a culture of innovation, to get people feeling like entrepreneurs, to get people, feeling hungry to come in and look for ideas. And so if all of our job entails is just doing plain vanilla, looking at things that everyone else looks at, it's really difficult to build up that culture. And I think that culture of innovation is super important for us to be competitive, for hiring and retaining, but also to generate outsized returns.
I agree. Thank you. So just want to make sure that we leave a little bit of room here at the end for more questions. So folks on the Zoom or in the room, if you have questions or you'd like to make comments, please avail yourself of the mic or raise your virtual hand. Just as we close out here, Anton, just what are the things that you're looking at in private equity, over the next 12 months here, just in terms of your leadership of the shop? We kind of heard the CIO's vision broadly for the investment office. For your particular group, what are you focused on in order to earn what you need to earn?
Yeah, a couple priorities include diversifying the private equity portfolio by including more venture and growth, and not having such reliance on buyout, and just to define the terminology, venture would be the earliest stages of company formation. Growth are growth investments are characterized by established firms on a very rapid trajectory until they reach maturity, and it's at the mature stage that we have buyout. And there are different drivers of returns. So, with buyout, there's the use, for example, of leverage, and with venture, there's not. So you're enhancing the diversification of the portfolio in several respects as you participate in the broad spectrum of private company ownership. And then the second major priority I would flag is co-investments, where we're investing in the same companies that we would invest in through the fund structures that are the bread and butter of private equity, but we do so at much better cost basis, much lower cost, and so we have a lower gross to net spread.
Thank you. Do you have a question here in the auditorium? Go ahead.
Yeah, thank you. My name is Sarah Thies, and I am part of Fossil Free California, and thank you very much for that very interesting presentation. I was really happy to hear about the renewable focus in PE, but I am thrilled to have the chance to ask a question that I've been wondering about for the 5 years that I've been attending and commenting. And I'm a CalPERS retiree. So my question, you won't be surprised, is about divestment. And let me just give you maybe 3 assumptions where I come from with that question, not understanding why CalPERS does not have that in its toolbox. So the first is that I think there's more and more evidence, and lately, for instance, MSCI index without fossil fuels is doing better than the one with fossil fuels. And it was already mentioned here today, I think, about the risk and the volatility of fossil fuels. And there's also a large consensus across all published studies that there can be no more development of new oil and gas. It's completely incompatible with 1.5 degrees. And I know that that is, I believe that CalPERS still holds that out as its goal. And then finally, CalPERS is the second largest holder of fossil fuel expanders among members of the Net Zero Asset Alliance, with at least $6.7 billion in stocks and bonds, including coal, $1.1 billion. And so I'm talking about within that large number you mentioned, 160 million, just the ones that are expanding fossil fuels. So that's just some of my background, and I've always wanted to find out why divestment isn't even in the toolbox, as far as I can tell.
Yeah, I would say to you, listen, we got everything in the toolbox. What we're saying is we highly prioritize engagement, and we'll do everything we possibly can. It would be such a last resort for us to go to the divestment route. I don't think we're so black and white that we'd say we don't have a policy that says we would never divest, but we just firmly believe that engagement and kind of going where the emissions are. It's a shame we were supposed to have an awesome session yesterday with Mark Carney, who's really a thought leader in this area, and he will be coming back. We hope to have him back for our board meeting in March to do the session we are going to do, because it was precisely on this topic. Like, why bother engaging with people who are such poor emission, leaders around the globe, and, walking through kind of the thought, the approach, the benefits of engagement, the idea of how to work with these groups over time to make sure they're hitting all of our goals of the 1.5. And so hopefully you'll be able to attend, and let's engage again after that if, it's still not clear to you why we put such a huge emphasis on the engagement bit. And I mean, ultimately, if we've done 100 things till Sunday and we're still not seeing any benefit, et cetera, then of course we're always going to have a conversation amongst ourselves, with our stakeholders, with our board, on what do we do in this situation. But we just have to prioritize the engagement bit, because the black and white approach of just divesting just isn't going to help any of us get to where we're all hoping to get to and working towards.
Yeah. I don't think we're like you have to divest everything today or anything like that. But I guess, just to repeat sort of my first point, what we've been trying to do since I've been involved with Fossil Free California is make the financial case for divestment, which seems, it just grows stronger every year. So I'm not personally asking about engagement. I feel like that's separate. It's a good thing to do, but it just seems financially all the information about why fossil fuels are not a good investment.
Yeah, and again, it's tough, and I wish I had the slide here, but the slide that I see as a CIO is that that is the only part of the sector that performed last year. So it depends on how the numbers are cut, and that is, and we're not leaning in or out based on what that statement I just made. It's just the devil's in the detail. As a pension plan with almost $500 billion, the whole notion of divesting when it's such a part of the entire economy is so complex when it comes to fossil fuels. And we are using our heft to engage best we can with the worst emitters so that we can start to see some traction. If we don't hold them accountable, my goodness, who is going to hold them accountable at the end of the day? And it's just philosophically, we have our things that we're seeing where we're getting traction. We feel good about some of the worst emitters and the approaches that we're taking with them to get this traction. We're holding ourselves accountable to make sure we're tracking this. I have our team giving me feedback on any of the things we flagged as, this is an up and coming engagement that we have. Here's our goal. Here's the process we took. Here's how we communicated. Here's the response we got. And now we will have an MID of sustainable investing that will be able to have the street cred to not only talk about the advocacy bits, which are super important, we've been thought leaders on, but start investing the dollars behind this as well.
Okay. Well,
into renewables, et cetera.
I'll be back in March. Obviously,
Great.
I don't agree, but I'll definitely be back in March. And I really appreciate that you and I hope the board are willing to talk about this more, because we haven't heard anything about the actual issue of this, find it being such a poor performing over time sector. So thank you.
Thank you.
Thanks, Sarah. Okay, we're nearing the end of our time here. Are there any other questions or comments? Anyone in the room or on the Zoom right now? Not seeing any. That one hand is unpull-downable. Here, I've been trying behind the scenes. It is just tantalizing there, isn't it? Yeah, so let's go ahead and move now into our more formalized public comment opportunity then. So again, as distinct from just asking questions, anyone wish to offer public comment in the room right now? All right, and anyone on the Zoom wish to offer public comment? If so, go ahead and raise your e-hand. All right, not seeing any there. I do believe that we have one person who is calling in to offer public comment. Go ahead. Kelly, are we able to get this person on the line? Okay, one moment, please. Technical slog. I do see, while we wait to get that person on, I do see Robert Gerling would wish to offer public comment. Robert, go ahead.
Thank you. I just wanted to go on the record that saying that California State University professors, retired professors, CalIRFSA, has gone on record as favoring divestment. And I just wanted to put that out there, as we're a significant group of members, and we've thought through this and support very much the statements which were made by Sarah Theis. Thank you.
Thank you, Professor Gerling. Okay, any more luck on the public comment line, Mr. Fox? Well, if you're on the line, if you could hear me, if you could please call back in later on in the session, we'll make sure to give you the opportunity to offer public comment. All right, so let's go ahead and break for lunch now. I'm showing 11:57, so if you could please return at 12:45. Thank you. Test, test. All right, welcome back. We'll go ahead and get started here on the back half of our annual stakeholder forum. I'd like to welcome back everybody who's joining us on our Zoom line. Apologize for little technical tweaks that we're having. You may have noticed a few folks seem to have their virtual hand raised, and we're just rudely ignoring them, I assure you. They're not intentionally raising it, nor can we lower it for them. So we're exploring that little wrinkle. But again, as in the first half of our forum, if anyone on the Zoom does have a comment or a question, we encourage you to raise your hand or enter it into the chat, and we can verbalize it for you. So we're going to begin here with a third of our 4 segments. My guests for this one are 2 of the longtime stalwarts of CalPERS. We are joined by Anthony Sweeney. Anthony Sweeney, he is our Deputy Executive Officer over all of customer services and support, which encompasses somewhere between 1/3 and 1/2 of this entire organization. Basically everything that touches members and employers. And then also by Renee Ostrander, who's the Chief of the Employer Account Management Division, who, as you can guess by that title, interfaces with our employer community quite a bit. Anthony, how long have you been at CalPERS? 50 years? Born and raised here?
30 plus.
30 plus years? Renee, how about you?
I just under 30.
Wow. Okay, so we got more than half a century of experience in this field. So encourage the tough questions here. No softballs for you two. So Anthony, why don't you want to start? Do you want to start off? I know you had a few special folks in the audience that you wanted to recognize.
Yeah, I don't get too many opportunities to introduce my team, David, so I thought I'd just take this opportunity. You already introduced Renee, who leads our employer account management division and everything related to compensation and Social Security and membership enrollments. But also in the audience, all our division chiefs are here. So we have Don Martinez, who is over our member account management division. So he oversees service credit purchases as a main function, refunds, and other member account related issues. Then we have Corrine George. Corrine is the division chief over our customer experience division, which is our contact center and all related activities related to the contact center. Then we have Kimberly Polito. She is the chief over our retirement benefit services division. So processing retirement applications, complex issues like IRC 415B, COLA, purchasing power protection, also community property as well. And then we have Keith Riddle. He is the chief over our disability and survivor benefits division, and he does exactly what it says, adjudicates disabilities, processes disability retirement apps, and pays survivor benefits, and or death benefits, as sometimes referred to. And then last but not least, we have David Rubio. David is the chief of our customer education and outreach division, responsible for the 8 regional offices we have across the state, educating our members and some of our internal teams as well. So thanks for giving me that opportunity. It was kind of self-serving, so if you heard anything that you wanted to ask a question about, you could find one of them instead of me.
Cagey operator. All right, let's dive into it here. So let's start with you, Anthony. So we've got a lot of employers in the room and on the line today, more than our usual stakeholder forum. So thank you for all of you from those communities for joining us. Why don't we start kind of on the member side of the pension administration kind of function here at CalPERS. Anthony, can you talk us through just at a high level, what are sort of the education opportunities that we have for members as they move through their membership life cycle, from new employee, new to public service, experience, looking to retire, and then going through the process and coming out the other side receiving pension checks?
Yeah, David, I think it's a good time to talk about it since we've moved into this more hybrid environment. So I just wanted to talk a little bit about the various services that we offer and how we model our education. So we have our classes. We have individual counseling sessions. Many of our members will come in and visit one of our regional offices with an appointment. Just want to encourage that. And they can do that in one of our regional offices, or they can do that virtually. And they can either do that via video chat with one of our counselors, or they can just do a phone conversation if they choose. So those are, typically our most popular type of counseling sessions. They can also do group counseling. So they can sit in and sign up for a video chat or an in-person chat and sit alongside people who may ask questions that they're afraid to ask and build off each other. So those are also available to our members. And they can get the same excellent service, whether they're, in person or via the chat. We've seemed to optimize that over the last couple years and are doing really a good job at that. Next, we have our educational events. So they don't want an individual counseling. They don't want to be part of a class. But they want to just go talk to a variety of people on a variety of topics. And we have our CalPERS benefit education events, or as what we refer to as CBs, and we host those across the state. This year we've started to begin those in person, or last year, I guess, forgot, 2023. Last year we started to do those in person for the first time in a couple years. So those are, a member can sign up to attend. They can go do any of those classes at these events. They can also go to individual booths where they talk to people about their personal retirement account, service credit purchases, anything related to their retirement. And just to plug, we have our next virtual event, which is February 7th and 8th. So that's, February 8th and 9th. So that's coming up. We're doing these hybrid again. And then our next in-person event will be in Anaheim in March, on March 17th and 18th. So wanted to plug those. Then lastly, we have our on-demand resources. And these are basically geared towards our website, our calpers.ca.gov website. That's where members can go out and refer to many of the retirement or benefits publications that we have available online. I get a lot of my information on there. When I forget certain things, go out, check on that pub and educate myself on what that proper rule is or process. So I encourage our members to go there. We also have videos online where you can watch a YouTube video that is like attending a class or attending an individual counseling session. So for those real introverts who just want to watch a video and not interact with anyone, we have that available for them as well.
Very good. Just as somebody, those of you who are involved in CalPERS, whether you're board members or folks that are in this CalPERS, sort of like either you're an employee here or you're a stakeholder. I know you've experienced, like, once someone gets the idea that you're an expert on CalPERS, they're asking you personal questions about their own experience. And if I take this job, will I still keep my classic formula? And what if I come back? Like, I've worked here for 10 years and I still can't answer all these questions with conviction, really. Like, not so that I want you to make career decisions based on my recollection. So I just refer so many people to all of these resources and to the call center a ton. And just always say, like, because a big thing is that people oftentimes don't really know how to define their question necessarily. If you're not steeped in this sort of vernacular, it can be very easy to kind of misinterpret phrases and jargon and potentially make the wrong step there. So
we always say when we're told we answered the same question with 3 different answers, we always said, well, how did you ask the question? Right? So that's where it comes into play. And thanks for pointing this out, David. I wanted to mention, when you call our contact center, they are extremely knowledgeable, answer 90% of the calls on first contact, but they're not there to give you a retirement counseling session. So if a member calls and feels like they're being rushed, it's not that we intend to rush them, right? We want to answer their questions in general, but if they wanted to get more specifics about their account, we always refer them to a counseling session or a group class and sign up online into their online account to more fully educate them. So that's on purpose, and just wanted to remind our stakeholders of that.
Good. Okay, let's pivot to the employer side of the equation. So speaking of employers here, again, these folks are members in almost every case in their own right, but here they're wearing the hat of the person who is that finance director, that benefits director, the payroll supervisor, the person whose business, whose job depends on passing information back and forth with CalPERS. So I don't know, Anthony or Renee, I'm not sure which one of you wants to take this one, but what do we have in place for those folks?
Yep, I'll take this on, David. Our model is similar to our member approach, and then Renee is going to get into a couple specifics of hot topics that are out there, so she'll get into those details. But in general, our model is also classes we offer our employers. So those can be done on your work site, and those can blend kind of these member crossing over into the member education as well, where we'll come out to a member or an employer's site. We'll host one of those retirement counseling sessions that's specific to your group. So we offer that virtually or in person, but we also offer classes to the employees of the employer who need to learn more about the retirement or health benefit laws, rules, policies, and we're able to provide that information to them. That's where I started my career. And then we also give training classes on actually using the MyCalPERS system. And the MyCalPERS system is what our employers use to enroll our members, to submit payroll, to manage different things online. So those classes are offered. You have new employees, you need refresher training. We offer those throughout the state as well at our regional offices, virtually as well. Then we have our educational events. So you're probably very familiar with our annual CalPERS Educational Forum, held at various sites over the years. And that's where the employers, we had over 1,000 employers attend in 2022. We're scheduled to be in LA in 2023 in October. And here you can meet with not just Renee and I and all our team, but the health team, the actuaries, the investment team, various presentations, keynote speakers, as well as exhibit rooms where you can get specific information to help you as an employer navigate the CalPERS world. What you may not be as familiar with is our employer leadership dialogues. And this is where our team, several members of our senior leadership team, travel around to various sites and invite the senior leaders from your employer organizations and speak to the hot topics, similar to kind of what Renee is going to talk about. So Renee will come to those ELDs, myself. David gives a great overview of CalPERS investments and what's happening in general, similar to our opening session today. But it's what's ever happening at that time, and it gives you a chance to meet with us, the health team, whatever that might be. And we're doing those virtually and in person now. And then lastly, we do have the online resources or on-demand resources as well for our employers. The publications are available, videos, classes that can be viewed online. And also we have our portal where the employers submit all types of data to us, but we recently added some new elements where for like a service credit purchase, when a member requests to purchase service with us, they do that online. When there's an employer interaction piece, we're now able to communicate with the employer online. You're able to do anything without a bunch of transfer of paper like it used to be in the past. So happy to have that as well.
That is good. I've heard some member input on that process. I'm glad to hear that's gotten upgraded. So that's wonderful. Renee, did you want to add anything to this piece before we get into those hot topics?
No, he covered all of it really well. There's so many opportunities for our employers to interact with us, and even through our employer contact center and those calls and questions that come in, we always make sure to answer those right away as well.
And the circular letters are for the
big one.
employers. The circular letters online as an on-demand resource. Even if you're not an employer, even if you're a county system and you want to learn what CalPERS is put out regarding, benefit limits, compensation limits, retired annuitants, you can go search that circular letter database for a certain topic and find what CalPERS has been putting out in writing to the community. So I wanted to make sure I pointed that out as well. And then I didn't want to leave out the rest of the stakeholder group, but our team participates in the monthly stakeholder engagement briefings and then also the quarterly stakeholder events that David hosts.
Yep. Great. All right, Renee, you're up. So let's talk about the first of two kind of like bigger hot button issues, for the employers. But of course, if it's affecting employers, it's about members. So this first one is the issue of special compensation when employers are putting together MOUs, memoranda of understanding. And this can often be, burning the midnight oil type of high pressure situations where negotiations are happening, under the gun, and agreements are made, and then unfortunately retroactively it turns out that really we can't honor those agreements because they're out of alignment with our the rules that we follow. So can you just kind of walk us through how this works and then what the process is that we put in place to try to provide more service to the parties?
Yeah, thanks, David. So this has always been in place, but over the last few years, it's really come into focus, and that came through with a bill that had gone through, which was SB 278. And so for Pearl gurus that would want to read about it, it's 20164.5. But really what it talks about is disallowed compensation. And if something is defined as disallowed compensation, then this piece of statute also talks about the cost to employers for that disallowed compensation, depending on whether the member themselves were an active, inactive member, or if they were already past their retirement date. And so there are large costs that could come upon the employer's shoulders to burden if those are found. And so there are services that we have offered to help employers in this space. And with the advent of this bill, really what we've done is we've taken the opportunity to put a little more structure around that and to formalize our feedback groups, really in an attempt to help an employer early on so they can identify these issues and avoid mistakes later on. So one of the things we did was we developed a new website. So this new website's been up and running for about a year and a half, I think now. And an employer or even one of our labor partners can go in and they could submit their language to us on the website. So there's the ability to click on it. You can submit the language. You can talk to us about, provide us additional information or background, and send that to us. And what we'll do with that is we will do a consultation with you. We'll explain to the employer or the labor group, whoever submits it, we will have a conversation back with you about whether or not it's reportable. If it's not reportable, the reasons why it's not reportable. Maybe it wasn't offered to the entire group or class. Maybe it's a top step issue or some other type of, doesn't include the full conditions of payment. So someone couldn't figure out what that amount is. And so we'll provide that feedback to you so that that can be changed. The other thing that we also do is we will actually host a joint session. So sometimes we'll have, and it happens both situations, either we'll have employers or we'll have labor contact us and they'll say, you know, we're concerned about this language. We'd like to talk about it. Could you meet with all of us? And our answer is absolutely. So that way, everyone that's in the conversation is hearing the same questions. They're hearing us respond with those same answers and hearing the issues or the red flags that we're seeing in that language that would potentially not make it reportable. So we'll do that. And then at the end of that process, we have now developed a formalized response letter. So the employer will receive a response letter to let them know that the finalized outcome of the reportability of that item. So if we've worked together and we've come to agreement on language that makes it reportable, the final letter outcome would be that it's reportable based on this language. We do include other information to remind them about. There's always legal caveats that have to go with it related to if there's a court case that might change it or something, but certainly trying to offer more transparency and more accountability in the work that we do in this space. So that's one piece of it. The other thing we've done is we've added some other areas that are continually under development, and the feedback that we receive from our stakeholders, so from all of you, is what helps to continue to enhance that. We have samples of language on our website. So if an employer has a new type of special comp that they're wanting to pay and they want it to be reportable, we could have language out there that would be a starting base for you to start that. Or the other thing that we have that is really neat, and we found this is really undervalued. David, if you want to click on the next link. If you go to our website and you type in the word special compensation.
This is our intricate process here.
And you type special compensation into our search bar, and then you hit the little microscope or the little magnifier. This is what comes up for you. So it's our special comp reportability table, and it lists all of the items that are reportable for Classic as well as PEPRA members, and it explains to you for each type of, in each category, there are category tabs in the top if you're actually looking at it on the website, and then each of the types are listed below. So for example, you can see bonus. So is a bonus reportable? So for Classic members, yes. Sometimes there's some distinction as to whether safety or miscellaneous can receive something. So that's distinguished there as well. And then PEPRA. So for example, you can see with bonus, bonus is not reportable for PEPRA items. And then in that notes column, it really gives you special hints or triggers of questions to think about as you're starting to develop the language. So quite a bit going on.
Renee, what are, off the top of your head, what would you say are the most contentious or most commonly misreported items?
Bonus.
Bonus.
Bonus is
I was going to say uniform pay.
Bonus and longevity pay. Anthony mentioned that one. That one can, just because of the way that it's crafted, not necessarily because longevity pay is reportable in a vast majority of situations, but sometimes the way it's crafted, for example, only paying it at a top step, that can cause issues for that.
Yeah. Okay, we've got a question in the room. Hey, Deb, go ahead.
Thanks. So working with the schools, what I will say is, whether it's been, Marcy or Anthony's staff, Renee's staff, this entire row of folks, the staff has been great at helping us. I've got about 200 labor professionals out there bargaining contracts and having us have an equal voice with CalPERS, with the employer. And I think that's important in pulling those two pieces together because there's two sides at the bargaining table. But listening to, two very powerful women, Marcy Frost, Yvonne Walker, talk about how do we, communicate, some of these stories. What does transparency mean to us? And one of those is, to steal a phrase from Yvonne, is the telling of the story. So one of the tellings of the story is the positives, but the other is the negative. So I get those calls, and the staff here hear me whine consistently, of those members, probably, 2 to 3 a month, who have done all of the steps, the estimates online, the estimates through CalPERS, but when those first retirement checks come, they're $400 a month. Right now, mine, the one lady I'm dealing with, is $432 a month, less than anticipated. And it's because the employer did a lump sum pay rate entry, and the computer picked it up from 18 months ago. So it's that story also needs to be told, because there isn't an employer out there or a labor group or a member who wants to follow all the steps and then not have it be what was anticipated. And I believe if the employers knew the impact that has on some human who is not going to make it with $432 less than anticipated, we would get more attendance at the CalPERS workshops, more participation from the actual payroll clerks that are doing the pay rate entry.
Thank you, Deb.
I'll start. Okay. So the first thing I wanted to talk about was, I completely agree with you, Deb, and I've been really happy to see labor groups engage and ask for educational sessions as well. We do those because we want to make sure that everyone that is involved with determining a pay or determining what's included in a retirement allowance understands what's happening. So we have really appreciated that change over the last few years because that's something different that we're doing. And completely agree with you about the lump sum, which provides me an opportunity to speak about some of the things that we've done recently. In trying to do all this, we do a lot of education, we put a lot of things out there, but it still requires the employer to pull it in and to utilize that education. And so we've embarked on a couple of items in the last 2 years to try and help with that. And one of them speaks directly to what Deb was talking about with the lump sum. So the system would pull it, and it would include, so for example, if someone has a 12-month final comp, it may, and they retire mid-year, as school employees often do, it may pick up 18 months worth of special compensation when only 12 months would be included. And so we have made some significant changes internally in our systems to try and catch that. And we've been seeing a much higher rate of items falling from Kimberly's team in benefits for us to be able to review and catch those. And so it's gonna take us some time because these changes we put in, we actually put them in a year ago this month. And so with 12-month final comps, it takes, over 12 months to be able to cycle through that. And so, and when we see it jump back a couple of years, that's another red flag for us. Why is it jumping back a couple of years? It can, and that is possible with someone's final comp. It's just not common, and so it's worthwhile for us to be able to take a second look. So there's different things like that. We've been, as we review MOUs that our employers provide us, so now for incoming payroll, if we see something unusual in incoming payroll and the employer hasn't yet worked with us on their MOU, then we'll do, then those will also kick out to us in the payroll process. So it's before someone ever retires. It's before someone, has walked out the door, locked their door for the last time, and we're able to provide them education to make better decisions. And then Anthony?
Yep, I was just gonna make sure we mention the edits and audits that we put in. Also, I wanted to be clear that SB 278 that Renee mentioned, it doesn't cover employer reporting errors. So it only covers those things that were agreed to in the MOU. So I think there's still some misunderstanding out there that that problem that was just described can be solved by SB 278 and the employer's on the hook. They aren't, because it was just a reporting error, not something agreed to in the MOU. So I wanted to make clear that. We're also implementing some audits on the post side with Kimberly's team where we compare, you know, what did as long as it was a reasonable time frame from when the member got an estimate to the time they got their retirement check, what were discrepancies, right? We do quality assurance on calcs, but we haven't done this comparison, and we've been working on the criteria for that. So we could go in and say, why are these certain ones discrepant? And then we'd find out, oh, they're all related to the lump sum payments. Now that one we've been able, we knew that historically, which is why Renee put in these upfront edits and audits to try and catch them before they happen. But maybe there's some other things out there that are generating these discrepancies that we can find from these type of quality assurance mechanisms.
Very good. I have a feeling this may be another phantom virtual hand, but Greg Rosner, did you want to unmute and make a comment or ask a question? If so, go ahead. I don't think so. Okay, so we'll move on then. Again, if anyone wants to ask questions or provide their input, happy to take that. So Renee, let's move then to the even more. Do you have a question? Did you want, Larry? Go ahead. Go ahead.
Yeah, Larry Woodson, California State Retirees. Hi. So, talking about the call center, I had some complaints that during the open enrollment period, when you are deluged with calls, the automated callback system was not available. Have you dropped that, or is it still available, or what?
I thought I was going to avoid questions from you, Larry, since we're not talking about health. But no, it is still enabled, but if you call at 3 o'clock in the afternoon, you're not going to get the callback feature because we can't queue calls up that require staff to work until 10 o'clock at night. So we typically shut it off around noon, so it allows us to get all the callbacks completed by the end of the day, as well as the incoming calls that are being taken.
Oh, that's great to know. So you shut it off around noon?
Yeah.
Okay, it's probably afternoon callers.
Yeah, so again, those are typically in the afternoons that it's a little bit slower. So we usually don't need the callback feature in the afternoon, but during open enrollment, right, we would have, and we do have staff work overtime to get through the queue of calls from the callback, but we can't have them working all night. So that's the purpose of that.
Okay, thank you.
Thank you. Okay, I think we have a question on the line on the Zoom. So Carla Romero, go ahead and unmute and fire away.
Hi, thank you so much. Recently, we had an issue where we had holiday pay that was needed to be retro reported when earned. And it was quite an undertaking to do that every single, for the reportable pay periods for 12 months for like 60 individuals. And it would be really nice if the system could do a mass retro reporting or like similar entries where you could enter multiple dates and the same type of compensation in like one screen versus having to enter one by one, because it literally took about 50 hours. And we had to both adjust our internal financial system and then also the reporting for CalPERS so that they matched for future reference. So just a thought for those that have to go through the painstaking reporting process that would be appreciated in the future.
Thank you, Carla. I would love to hear more from you because I know we do have a couple of means to do reporting. So, for example, you can actually report, I'll take bonus. I know you mentioned holiday pay, but I'll speak about bonus. So if you have a bonus that's earned over an entire year, you can actually put the year's dates in, and it will spread it across the entire year. So we do have the ability to do that. I don't know if there was maybe something unique in your situation that wouldn't allow it, but I would like to talk with you more just for future. If you have anything to do, we certainly wouldn't want you to go through the individualized reporting, because we do know that that can take quite a bit of time.
Good. Jerry Fontaine, I see your hand. Did you want to make a comment, sir? No. Okay. Another phantom. We are haunted on the Zoom. Okay. Go ahead.
Hi, I'm Melissa Willett, board member, and I just wanted to make a comment. I recently had the opportunity to visit the San Jose regional office, and I just wanted to shout out and give kudos to Kevin Kaufman and his staff over there in the San Jose regional office. They gave me a tour, provided me tons of materials. We talked about how do we get members virtual appointments, and it was amazing. I hope to have more visits in other regional offices, but I just want to let you know their staff out there in San Jose are working hard and diligently for our members' benefits, and I'm appreciative. Thank you.
Thanks, Melissa. Really appreciate that. David will pass it on to his team out there.
Very good. Okay, Renee, let's go ahead and let's talk about probably the most top of mind issue coming out of your shop right now that I'm aware of, at least, and that has to do with these limited duration regs. So those of you who have been following this issue, this is also not cooperating. This has been sort of brought to the board a number of times for consideration, and it's been discussed and vetted amongst the member community, the employer community, back to the member community, and it's been a road. Can you just lay out for us what this means for those who haven't been engaged, and then where we are in the process of implementing these regs?
Yeah, absolutely. So in the world of post-retirement employment or working after retirement, affectionately called WAR, and it seems that way lately. For retired annuitants, if someone comes back to work, there are a lot of requirements, and we'll talk about that a couple of slides from now. There are requirements that are already in place for statute. So what this regulation is trying to do is there is a term utilized in the statute that says limited duration. So it's trying to define what limited duration means. So how the proposed regulation that has been brought forward to the board thus far, it is defined as an individual can work up to 24 months, a retiree, and then beyond that, if the employer is still in need of their specialized skills, then an employer can do 2 one-year extensions. Those are all employer-driven, so the employer would complete the requirements that are listed in the reg, and then which does include a resolution, and then once that's complete, they would enter it into our system to receive the extensions, and those 2 one-year extensions then take it to a 48-month appointment. So the regulations also offer an option that if the employer is still in need of their specialized skills beyond those 48 consecutive months, then there is the option for 2 possible extensions. One of which is a lifetime exemption, and that exemption has to do if the retiree is being utilized for a very minimal amount of hours, and so what we're talking about is less than 120 hours in a fiscal year. So very, very small. Maybe you bring them back twice a year for a week or so to do some kind of processing that's needed, that's very unique to their skill set. The other exemption possibility is an annual exemption process, and that one, again, there's more rigor and there's more transparency in terms of the requirements by the employer, and then once that process is completed, all of those documents are turned over to my team, and my team will do the review through. There's an approval process to go through, and then each of those that go through that process would be presented to our Board of Administration for review. So that's how that process works. That's the traditional path. There is an additional side path. We do have some groups that have defined time frames for a retired annuitant in their collective bargaining agreement. So they have very specifically defined how long someone could work for them. So in that case, we have allowed a different path. So, and it can be up to 5 months. So no one could have an MOU, or 5 years, thank you. No one could have an MOU that says they could stay for 10 years. That still wouldn't be allowed. But if they have an MOU that says up to 60 months or 5 years, they do not have to go through the extension or the exemption processes for that. They would just have a single appointment that could be up to, it doesn't have to be the full 60 months. Again, it's based on the employer and the need for that specialized skill set as a retiree. So, and I'll pause on the retiree because I know we have a question.
Sure. Yes, we got a question in the auditorium. Please go ahead.
Carla Helden. I am a retired annuitant, and so when you talk about you can work up to 24 months, I've been retired for 10 years, and they occasionally call me back to fill in. So when does this 24 months, and does that apply to me?
So once this regulation's still in draft form, and it's still got a number of stops to make before it would be published by the Secretary of State. And so none of this will apply until that happens. So this is all education about how the draft regulation would work should it be published. But yes, it would apply to all retirees once it was enacted. It will start, one of the things is that 24 months starts from the date of publication. So for example, if this were to be published in July of this year, then that 24 months would start in July for everyone, regardless of past appointments, regardless of time you've spent before. So, and it is a continuous 24 months. So I know you mentioned, they call you back from time to time, but that 24 months would start on that day.
Thank you.
You're welcome.
And then Renee, is it 24 months of real time, or is it like, let's say that someone worked 3 months 1 year, 3 months the next year, was that 2 years or was that 6 months?
The 2 years.
Okay.
So it's continuous months. So it starts from the date of that appointment.
Very good. I think it might be helpful to skip ahead just a little bit here. Can you outline for us who is not impacted by this? Can you just kind of define the differences here? Because I think there's probably a lot of wheels spinning thinking, okay, who does and doesn't this apply to? Is this me? How does this change my life? It's not exactly the same stroke for everybody.
Right. So as I was mentioning in the beginning, this draft regulation just applies to the term limited duration. So all of the other requirements in place for retirees still remain the same. So if you work on this slide, if you work from the bottom up, you've got an independent contractor. An independent contractor is not subject to any retirement rules. If they are a true bona fide independent contractor, they're not subject to retirement rules, they're not subject to the hours, pay limits. It's not common. I would say it's actually very uncommon, but it is possible. We have seen it. I've reviewed situations before where it has been in place, but very uncommon to see someone who devoted their life's service and their career to public service to then come back as an independent contractor. It's pretty unique, and it typically requires just a different spin on the type of work that they do to truly be independent. But this does not touch a true independent contractor. The top one is interim appointment, and really what we're talking about in interim appointment is those individuals that are coming back to fill a unique, specific position. So for example, at a public agency, it could be their city manager, or at a district, it could be their general manager. So you have a very unique position. The individual retires or leaves, and who's immediately available to you is a retiree. Those individuals come back and they have to, there's a whole set of criteria that's already in statute related to interim appointments. So they would still have to follow all of that. And then with extra help, you have emergency situations. Those are limited. But again, with all of these, all of the additional statute requirements still apply.
So for the interim appointment, I mean, can you just drill down, like, what's the difference between that and just being hired back to do your job? It sounds like effectively the same thing. You were retired and then they needed you. Is there a difference in the verb of appointment versus coming back to work and working after retirement?
And it really has to do, there's a little bit of a nuance to it. It's not always abundantly clear. But generally speaking, when we're looking at interim appointments, we are looking at those higher level, unique positions. So it would be someone that, like I said, a city manager that leaves, and then they bring a retiree to fill in as the interim city manager, or they bring someone to fill in as an interim CFO with all of the responsibilities and all of the criteria. Whereas when we're looking at extra help, it could be, an example would be police officers. And so you often keep additional police officers on reserve that can fill in. Like if you have, during COVID, we saw that quite a bit, where they'd have an additional set of officers that were available to fill in if they had too many people that were not able to go to work. So that's typically where you see that distinction.
And I think the critical thing here is they're two different government codes. So that there's a separate government code that governs interim appointments, and it doesn't use the term limited duration. Right, so there's already a time frame you have to define when you bring in an interim city manager. So you tell us up front, I'm having this interim city manager for 8 months. And during that time, the government code says you have to have an active recruitment going on, blah, blah, blah. So there are already specified criteria that you must meet. This limited duration definition doesn't tack on to that. So I think that's what Renee points out is the critical difference, whereas the extra help is a different government code that says you can do this for a limited duration. Right, and that's where this regulation really comes in.
Okay, let's hop back to this one real quick. So back to, now that we've excluded like who's not part of this, back to the large cohort that is potentially going to be influenced here. Where are we in that sort of process of getting this turned into statute?
So currently, we just completed our second round of public comment. We did a 15-day public comment period. After our first round, we received a lot of feedback. I think Anthony affectionately says we were probably a little too close to the language when we put it out because we tried so hard to get it all right. We were awfully close to it, and so that first round of comments really aided us in providing some outside feedback in trying to help understand where people still had that confusion. And so based on that, based on concerns of operations, et cetera, we made some changes to it when it came forward to the board for a second time. I believe that was November. I believe it was November. And so, and it was approved to go out for public comment again. And so that public comment period happened during December. And so now in the very near future, based on all of that review, we'll be bringing that forward to the board once again to make a decision about whether or not more changes are necessary, or if we would move forward the language that we have to to the Office of Administrative Law for review. Still has to go through that process. There's a lot of interaction between the Office of Administrative Law and ourselves that likely could end up with an additional public comment period. That's pretty common.
Goodness gracious.
And then that would be the final, would go forward for approval and then publication, and it takes a quarter to publish it. So I would believe that should this be published, it would probably be in the fall. It's still a lot of time.
Of 2035.
Yeah.
Thank gosh.
Yes.
Okay, we have another question in the auditorium. Go ahead.
Okay, this is Carla Held again, and I want to ask about this. What is the reason for this? Because we know that schools have such shortages in subs, and those younger, active, retired people still like to go back once in a while to subs. So what is the thought for limiting the duration? What does this regulation provide?
So the statute actually tells us that the work is to be of limited duration. So it's about trying to define the term limited duration so that there's a consistency and uniformity across our retirement system for how limited duration is applied. But it is essentially based on the fact that the law does define that work is supposed to be of limited duration.
It's more from a compliance perspective when we're asked, oh, you know, okay, so this must be of limited duration. How do you control that? How do you manage it or mitigate it? Oh, well, we don't really know how long that is. So we had to put some definition around it. So this is our effort to put that definition around it. And again, I say this often in our communications is, as long as the appointment is legitimate and the retired annuitant is performing the duties with the skills as outlined in the law, then this regulation gives you the opportunity to continue that retired annuitant relationship.
Okay, I heard your answer, but it's just sad that we have to put a limit on how the duration of how long people want to work. So, thank you.
Thank you. Any other questions or comments on this one? This is definitely a hot button one. So anyone on the Zoom, if you wanted to unmute, you can, or raise your virtual hand. All right, not hearing any. Okay. So we may come back to that one at the end. So Anthony, our last topic that we did want to hit on are our efforts at going green at CalPERS. You know, been an ongoing initiative for a long time. Obviously, this squares with our overall approach to sustainability in our investments, in the way that we run the organization. But here it is trickling into the way that we're engaging with members and employers. Can you just walk us through some of the big initiatives and where we're looking to get those savings and go green?
Yeah, thanks, David. I think the goal of this slide was just to remind our stakeholders and our members and employers all the things that are available online for you. So, you know, an active member can go online, get an estimate. They can apply for retirement online. They can send us inquiries. They don't want to be queued up on the contact center, so they can go send a secure message that goes to our program areas to respond to. We just added functionality where a death can be reported online, whereas before they would have to call the contact center. We're adding some new functionality where we can send out our condolence packages. So one of the things is that the death benefit process can be cumbersome, and there's a lot of paper, and we're mailing things back and forth. We're putting together this ability to transfer these condolence packages online. The health space has a lot of online functionality already. Moving over to the retirees, they can pretty much function independently online. So many functions for them to perform without ever having to reach out to us, where transactions are being processed online. And for our employers, most of our business is conducted online. And I'll just add, through all these efforts, we've been looking at this over the last 2 years, we've saved over $40 million by just being able to implement new functionality online by transitioning a lot of our processes and functionality online, consolidating our publications. I mentioned all those publications that are online. We're trying to get more streamlined with them, and so it's really making a difference.
Great. Larry, go ahead.
Well, I sound like a broken record, I know, Anthony, but there are still a number of retirees out there that, like my 93-year-old father-in-law who doesn't own a computer and doesn't want one, and a lot of others that just aren't real proficient. And we still have direct deposit notices that are not being mailed out from the controller's office. I actually raised this with the new controller who, when she was running for office, as a point of interest for us to reconsider. So you guys are great in that people can phone in and get a copy that way, but they have to phone in every month for their copy. So one question is, can you, for those few that want it, can you just make it an annual request and replace the function of, I guess, the controller? Or do you have any evidence that the controller will reinstate that for those people that it's important to get?
I was going to ask you, Larry, what did the new controller say?
Well, she said she would look into it.
Okay. I'm going to give you the same answer. We're going to look into it and see what options are available.
Okay. Thank you.
Meet your needs.
Okay, we have another question or comment in the auditorium. Go ahead.
Eleanor Fretwell, is there still a paper shortage?
That was on the state controller's office side where they were having some supply chain issues with the certain types of paper they were using to produce that. So I'm not sure if that's still in existence on their side or not, but.
So if it's not, that means we can start back getting our pay warrants and stuff like that, because I was told that's why we didn't get the stuff.
Yeah, that's just one part of the equation at the time. Okay. So we're going to look at what options are available.
Okay. And I'm not 90 years old, but it's still hard for me to get on the website sometime too to find my stuff and know what's getting off. So I still would like my stuff mailed to me. Thank you.
You're welcome.
Okay, we got a question in the chat. I think this has to do with the Replacement Benefit Fund. It's a different acronym, but currently, as far as I know, the RPB payments can only be issued by check. Will CalPERS be allowing direct deposit to go green?
Yes, the Replacement Benefit Plan or Replacement Benefit Fund, yes, those are separate paper checks that go out to those approximately 1,500 individuals who are part of that plan. We continue to work with the state controller's office to create direct deposit for that. So we're actively working on it. We're engaged with them, and we hope to put that in place. But there are certain requirements and audits that need to be met in order to make that happen. So we continue to work on that.
Good. Board Member Walker, please.
Oh, thank you. So I just wanted to go back to the mailing out of the pay stubs. So I was having a conversation, and I can't remember now who it was, but when the Fed switched over to all electronic, they actually had a cutoff by birth date. Like, so after a certain date, or before a certain date, you'd get it. So like like a lot of the other people who spoke, my dad's 90. He does not go online for anything. I am his online. He calls me up, lets me know what he needs, and I am his online, so I get it. But I think it's when you're entering into the conversations, because this is the second meeting where we're saying, like, we'll look into it. And I think that we should look for, I don't know how we're looking for solutions, so if there's something you need from us to help to get to solutions, I want to make sure that we offer that too, because this should be relatively, it's a will, in my mind, a will thing and not a we can't do it thing.
Yep, and that is, instead of saying we'll look into it, I'm committing to looking at options. So that would be, a viable option.
Okay.
But Eleanor still wants her statement, even though she's only 40.
She can go
She's not your target audience.
Clearly take the checks from the replacement benefit fund and send it to the retirees. Okay, yes, we have another question in the auditorium. Go ahead.
Yeah, but I want to back up to the duration. Am I allowed to?
Yes.
Okay, so this is what's in my head, and if you guys knew me, you would know it's really a place in there that you don't want to be. So what I was listening to and hearing, and I retired and never went back a day to work, okay? But I have a lot of members that do go back and work. And when they retired, before they just went right back, and then it was they had to wait 6 months. But it was something that they planned on. They looked at, this is what my retirement check is, I can sub, I can do this. And that was kind of like the contract they had with CalPERS and their retirement, was that they were going to be able to work for all that time. And it seems like now it's like, okay, you get 2 years and that's it, but they retired before that happened. So, you know, I'm not understanding how this works for the income for that retiree that retired on the promise of.
Well, so it's not just limited to 2 years, right? So they can extend that with an agreement between the employer and the member. So I wouldn't consider it a guarantee that, right, because the law always said a limited duration. The question is, how long is a limited duration? So I'm not sure somebody would say 6 years is a limited duration of time. So there was already a requirement in there. It's just difficult for us internally to administer that. It's difficult for the employer to know how long, or for the member to know how long can they actually work in this job before they're going to get a violation. So that's the ultimate goal, is to just try and make it easier to comply with the law. So that was the purpose of defining the limited duration, so that the member still has the retiree still has the opportunity. Again, if they meet all the criteria that's laid out in the law, they can continue that employment beyond 2 years, as long as the employer's in agreement and continues that through the extension process and ultimately the exemption process. And I would also bring up that the member always has the right to reinstate as well. So if they're finding themselves coming back time after time, they're probably better suited to earn more service credit, potentially a higher final compensation if they're that needed in the area, and increase their retirement income by improving their factor on their age, etc. So.
Thank you.
Thank you. This will have to be our last question before we take public comment, because we do need to get to our next topic. So this shows us just someone from Human Resources from Butte. I think I know who this person is. So if you are there, go ahead and unmute, and we're ready.
Good afternoon. It's just kind of a follow-up comment concerning some of the retirees. While we love our retirees and they love us and they contact us repeatedly for help with PERS issues, we know that in reality that they are a CalPERS member. They're not our people to take care of. We're reminded that every time we call the call center. But in reality, especially during open enrollment, the retirees are very frustrated, even with the call center. When you get a retiree that's called in 4 times to get help with a specific issue, and we know that you're recording on your notes in their profile what they're calling about, it seems like the help center should be reviewing those notes and understanding that for some reason they're not getting to the issue, and to be able to help them. They'll call me and I know exactly what the issue is, but then I'm unable to resolve it with you folks. And I think that there needs to be a little bit more effort made when offering customer service to our retirees.
Yeah, understood. I'm sorry to hear that. And happy to have you reach out to me and we can look into specifics. We do have a quality assurance team that reviews a significant number of calls to make sure that our agents are providing that optimal customer service. The wait times can be a little more troublesome during that open enrollment period, but we have made strides on that over the last couple years and really reduced the wait times during those periods. And we do review accounts and try to improve on anything we can in our training efforts. So happy to have any specific feedback provided to me as well. So thank you for the comments.
Thanks, Anthony. All right, so we've run out of time here. You got one? Come on.
Karen Fassler. I have a comment and a question related back to the replacement benefit fund. So in December of this last year, we got the circular letter that indicated once we received the invoice that if it was paid by the 31st of December, our retiree would receive their payment by January 31st. The timing is really difficult for a public agency to manage. We did not get the invoice in our portal until the 20th of December. We didn't get a paper copy of it until I think after Christmas. And it was delivered to someone who was seemingly a random who the system chose to deliver it to. And we think we have our contacts set up properly. So is that something that CalPERS can work on as far as when we get the invoice so that we can make our timely payment for our retirees' benefit?
Yeah, thanks for the question, Karen. It's really difficult to deliver these replacement benefit fund checks by February 1st. We put that language in there to say, hey, if you do get us the payment, I think we soften the language because we know it's hard for you to make that payment, and we don't want to give the member a false sense of security that they're going to get that February 1st check. So we are waiting on timing from the IRS on what those limits are. So that delays those invoices to go out in December. That's why they push so late in the month. The member does get the retroactive benefit on March 1st. They will get both months' payments. So the timing is really difficult. I mean, when I started as in the benefit services division, right, those payments weren't getting out until June. And the law says we have to make them at least once per year. So we try our best to exceed that, and we've gotten better over the years, but getting that February 1st payment is really, really difficult based on the IRS timing, our ability to then calculate all the limits and send out the invoices to all the employers. So the electronic delivery is helping a little bit, but I'd just try to back off that expectation of that February 1st check, which we try to do in our notifications to the members as well. But we'll try our hardest to get those out as timely as possible.
Appreciate it. Thank you.
Great, thank you. Okay, so now we're really out of time for this session. So let's pause here. Does anyone have any public comment that they'd like to offer? Going once, going twice. Sold. Okay, Zoom. Anyone on the Zoom want to offer public comment? Not seeing any. Jerry Fontaine has had his hand up for an hour. Okay, and Kelly tells me that there's nobody on the line calling in. So that will conclude this panel. We will take a short, let's do a 5-minute break. So please come back at 2:02 because I know we have a hard stop at 3. Many of you have flights, so we'll get you out of here on time. We just need to reconfigure the stage, and you'll get a new moderator.
Good afternoon. I'm Lisa Albers, the Assistant Chief of the Clinical Policy and Programs Division here at CalPERS. I had the pleasure of working with the team on various medical and pharmacy-related initiatives, as well as behavioral health and advanced primary care. Today, I had the privilege of moderating this session with this amazing group of panelists that I think are familiar to you. We have Don Moulds, our Chief Health Director, Rob Jar-Zombek, the Chief of our Health Plan Research and Administrative Division, Julia Logan, the Chief of our Clinical Policy and Programs Division and our Chief Clinical Director, and Yesenia Croft, the Chief of our Health Account Management Division. We're going to speak with each one of them today on various healthcare topics, and then we look forward to your questions at the end of the panel discussion. So Don, we'll start with you. Did you want to say anything before we dive into the first question?
That working? Great. Yeah, no, I wanted to just take a second and acknowledge some of the recent changes in the team and just the overall terrificness of the team that we've assembled in the health division, or in the health branch. Starting with Dr. Albers and Dr. Tefera. So I told Ramon Rubalcaba that one of my New Year's resolutions was to get our two medical consultants working with Dr. Logan in front of the board and the stakeholders more often, because they are both huge sources of knowledge. You heard from Tef yesterday moderating what I thought was a terrific, very informative panel, and Tef has deep background as a Brookings Fellow in the U.S. Senate and in various federal capacities, and as a practicing physician. Dr. Albers, equally terrific, brings a very deep understanding of healthcare quality and quality improvement, and has been instrumental in helping to weave that into the contracts, which are our mechanism. And Rob's going to go into this in detail, so I don't want to steal his thunder, but the primary mechanism that we use to drive quality improvement. Also wanted to acknowledge Rob in his new role as the chief of HPRA. So Rob has been a terrific leader at HAMD for several years now, leading all of the member-facing work that we do and much of the Medicare work. One of the things that I really admire in Rob is his ability to think long-term and to develop a terrific team. And part of that was having Yesenia there to step up and take the helm at HAMD when Rob moved to HPRA. So Yesenia has just been terrific. I dare anyone in the room to play Stump the Chump on Medicare with Yesenia. You'll lose. She knows that program better than just about anybody I've ever met. It's really quite terrific. I don't need to reintroduce any of you to Dr. Logan. Certainly don't need to reintroduce any of you to Kim Malm, but they round out the senior team that we have now in place. So just very excited and wanted to take a second to acknowledge all of them.
Thanks very much, Don. So we will dive into the first question here. We are experiencing significant inflation across the board in the cost of food, goods, and services, and healthcare is no exception. So how do you see inflation impacting healthcare and healthcare costs in the coming year?
So thanks for the question, Lisa. It's a good one. As I think most of you know, keeping costs low and healthcare affordable is one of our strategic goals in the branch. Obviously something we think about every day because it is such a challenge in healthcare. And I will add that inflation, general inflation rates nearing 10% these days is not helping matters. There are a couple of areas where we need to pay particular attention, and I think have been and will continue to be in the foreseeable future drivers of healthcare costs that come out of general inflation. One is labor costs. Healthcare is very labor intensive. It's not news to anybody. But as there are we see general increases in labor costs and shortages of workers, that is going to be affecting the cost of healthcare. Very understandable as well. It's the fact that this is a particular workforce that has been put through the ringer over the last couple of years. Many of them, and not just doctors and nurses, but people who are cleaning rooms and providing other services that you don't typically think of when you think of healthcare, literally putting their lives on the line during the COVID epidemic pre-vaccine. And so understandably burned out and in need of help making ends meet as we see general inflation in the cost of services and goods themselves and the things that they need to pay for. The other area, and we think of this much less commonly, but healthcare settings are incredibly energy dependent. So hospitals in particular use tremendous amount of energy. So when you see energy costs going up, that's a cost driver, and material costs. So think about all of the IV bags and titanium stents and gauze, and the cost for all of those materials go up. It affects healthcare. The good news in this is that we have not seen healthcare, the costs in healthcare go up. I should say the prices in healthcare go up as much as general inflation. That's a yet, but it's something that we're monitoring rather. The other two considerations that are sort of really important and we're thinking a lot about as we think about where prices are going is one, the demand for services, and two, just the general state of the health of our members, really all Americans at this point. I just wanted to say a little bit about that. So we saw during the COVID epidemic, as we've talked about at board meetings and in other places, we saw a tremendous decrease in the use of healthcare services. Some of it was anxiety about going into medical settings. Some of it was just the cancellation of routine surgeries and other procedures. And then we saw incredible uptick in utilization right at the beginning of 2021 when Americans and our members went pouring back into the healthcare system. And we really haven't seen that let up. And that will be an ongoing driver of healthcare costs. The other issue that we are concerned about for multiple reasons, not just cost, is that Americans and our members are not as healthy as they were before COVID. And there are a number of reasons. One is that they were not getting the routine screenings that they would have typically gotten had they been seeing their normal routine caregivers. They haven't been as successful at managing chronic conditions during COVID. So think about people managing diabetes or multiple chronic conditions without the intervention of a provider in person. Now, some of that was made up through telehealth, but it did not keep up as much as we had hoped. And then the third is that a lot of people just are coming out of COVID, and I'll speak for personal experience, from personal experience, but are just not as, they were sedentary during COVID, they weren't maintaining their health as well. What we don't know is how long this is going to keep up. Ashish Jha, who runs the COVID response for the White House yesterday, said he anticipates this to go on for at least 3 more years. I have no idea how he came up with that number. It sounds like it could be right. Be interesting to hear a little bit more about why he thinks it's going to be 3 years. But we know that it's still going on. We just don't know how much of it is permanent and how much of it is temporary.
Thank you, Don. That was quite a number of different factors. I'm going to hone in on one of the things that you mentioned in your response. There's been a lot of news coverage recently about physician burnout and a shortage of healthcare providers. We all know people who have struggled to find a primary care provider that's accepting new patients, and we know that there aren't enough behavioral healthcare providers to meet demand. So can you tell us more about what you're seeing and hearing about the healthcare provider supply challenges?
Sure, and I'm glad you use provider and not physician, because one of the things that's important to point out is that this is, one, burnout is real. Two, it is not just a doctor problem. It is across the spectrum of healthcare problems. So we talked about all of the people who were putting themselves at great personal risk during COVID. Those were not just providers. They were also people working in hospitals and other capacities. So it is a very real concern. All of those folks, in addition to working those hours, they transitioned almost overnight from an environment where they're putting themselves at great risk to an environment where everybody is coming flooding back and wanting to know why they can't get an appointment yesterday. So if you take away one thing from this discussion, take away this: when you go into a healthcare setting, be nice to the people who are trying to treat you. They're there because they care about you, and we're all in a bad place if they quit. The challenge again is that we don't know. I talked about it just a second ago. We don't know that there are shortages everywhere in the healthcare system right now. People are having a hard time getting appointments for just about everything. I talked to I will not mention the health system, but a person I know who works in one of the major health systems that services Sacramento, who said, we don't have a single person in our hospital right now who was admitted for COVID. We have people who had tested positive for COVID when they're in for other things, but we are at 100% capacity. And I said, well, why? And she said, well, we're still trying to figure that out. And it's just an inflow right now that the system is having a very hard time dealing with. We are hopeful that, as I said, is due to some temporary considerations, but we're still trying to figure out how much of it will be ongoing. There are two areas where we are particularly concerned. One of them is primary care, and the other one is behavioral health. Primary care is a long-standing challenge, finding adequate supply of high-quality primary care, ongoing challenge in the health system. There are a lot of reasons. One is the disparity in the salaries that you see in primary care versus specialty care. I had a colleague several years ago who wrote a paper. Those of you who know me know I love benchmarking U.S. performance and issues against other countries, but benchmarked primary care provider pay and specialist pay, and I think compared to European nations, primary care was about 20 or 30% higher if memory serves, which can be accounted for in the fact that American physicians usually have loans when they come out of medical school and so forth. An orthopedist was making 7 or 8 times what a European would make. So you see these huge disparities, and there's an economic incentive not to go into primary care. We're working with our other purchaser partners, with Department of Healthcare Services in Covered California, to look at larger systemic solutions to the problem. But it's not a nut that we're going to crack overnight. Behavioral health care, so there was a huge increase in demand for behavioral health services, particularly for the treatment of anxiety and depression. And we had shortages before we went into the COVID pandemic. That is going to be a longer-term challenge. We are looking at things like telehealth to help alleviate, particularly in some areas where you have really, really profound shortages, rural areas, for example. So we're looking at that. We're talking with our insurers about increasing network size and so forth, but that's another one that we're really needing to pay attention to.
Thanks, Don. And before we move on to Rob, we really can't have a conversation about healthcare without touching on pharmacy. So can you briefly tell us what CalPERS is doing to address the rising cost of medications and what you see on the horizon around medication costs?
Sure, I wrote down a couple of notes because I figured I'd run over time by the time we got to drugs and try to keep it concise.
Thank you.
Yes. So point one on drugs, so thanks for the question. Point one on drugs, we're in a much better place now than we were a few years ago on drugs. So we had a very bumpy transition from our normal contract to the acquisition price-based contract that we moved to a few years ago now. That's a contract where we're paying for the actual cost of the drugs plus the cost to procure the drug and the cost to dispense the drug. We are now in a place where I can say with a good amount of confidence that we are at the top of the market in terms of what we're paying, the top of the market or the bottom of the market, depending on what's the top and what's the bottom. But we're paying prices that are competitive with the largest purchasers in the country. And that's a really important place to be. Point two, there are actually some positive signs. Something you also don't hear much about or said when you hear someone talking about drug prices. So some of our most expensive drugs or our biggest costers are coming off patent. So drugs to treat rheumatoid arthritis and chronic bowel disease that have been real cost drivers are now starting to see competitors, and so we expect the prices on those to drop. Another thing that you don't always hear is that we're starting to see positive signs from government. So in the Build Back Better Act, we have now, for the first time, the ability of Medicare to negotiate drug prices. Now, it still doesn't happen for a few years, and it happens initially with a very limited number of drugs, so don't get excited about big changes right away. But that was an important, really important step. I'll also add that we've had a dialogue with CMS about sharing some of our spend data so that they have a better sense of where they go in the next drugs that they add to the negotiation list. So that's a very exciting development. On the state side, we're going to start, California is going to start manufacturing its own generic insulin, conceivably by the end of this year, probably more realistically next, and has made a commitment to looking at the manufacturing of additional drugs. Still lots of clouds. These specialized drugs that we're seeing that are in some cases real miracles are incredibly expensive because they only work for a very few number of people. We're going to be focusing increasingly on specialty drugs. So we have a few thousand people in the CalPERS population that use these kinds of drugs. And combined, they account for about half of our drug spend. So, getting close to $1 billion of spend, which is really quite remarkable. We think we can be working with them to make sure the drugs are working better for them, that there's less waste in that space, and working with those patients to manage their conditions better, we think is another place where we can save money and improve outcomes. So I'll stop there.
Thank you, Don. Thanks for that excellent background on the healthcare landscape. So now let's transition from that to what we're doing here with our program to help improve it through our contracts that we have with the health plans. So we currently contract with 7 health plan carriers, and through them we have about 20 different products. Those include our HMOs, our health maintenance organizations, our EPOs, the exclusive provider organizations, and then of course our own self-insured PPOs, or preferred provider organizations. And we're actually in the midst of right now planning for those next 5-year contract cycles for both the PPOs and the HMOs, as I know most of you are aware. And this is a really critical opportunity for CalPERS to drive some improvements for our members. So Rob, can you tell us how our new health plan contracts help our members and what it is that we're looking to really achieve with these solicitations?
Yes, thanks, Lisa. So as you know, our contracts are our most powerful tool that we have to instruct the plans on what we want them to do and also hold them accountable for doing what we're asking them to do. So right now, we're conducting the solicitation for our next 5-year HMO contract. And so this 5-year contract will be for 2024 through 2028. In this solicitation, we're doing a variety of things, all of which support improving quality, access, affordability, as well as equity. And so I'll talk through 3 different areas that we're working on through the solicitation. The first is that we're seeking efficient health plans. So we're seeking plans that have demonstrated ability to have efficient operations as well as cost-effective in the delivery of affordable care and providing adequate choice to our members. The second thing that we're doing is we're driving value for our members through competition as well as transparency. And so we want to make sure that the plans that we have in our portfolio are highly competitive, but also very transparent. And so we're looking at unit costs for each plan to determine where the areas of success are and also in other areas that might need improvement. Also with this, we're requiring all plans in the solicitation to submit 4 separate fee proposals. This is so we, CalPERS, can determine what is the appropriate contracting arrangement for CalPERS to enter into, as well as the one that provides the most transparency for us. So when we're looking at the administrative services fees they're proposing, we want to make sure we understand how they are building that rate so we can understand what we're paying for and then hold them accountable for getting what we're paying them for. So that's new this contracting cycle. The third thing, and it's also new this year, is building off of our collaborations, which Don mentioned, with Covered California as well as Department of Health Care Services. Through those collaborations, we've established some contract requirements and most importantly, some clinical quality measures. So we've established a focused set of clinical quality measures that we're really honing in on and holding all the plans accountable for. So it's both us, Covered California, and DHCS. Julia will talk about how we arrived at that focus list and what they are, and how those are really going to be working towards improving outcomes for our members. Also, and in collaboration with the other purchasers, we're assessing very similar financial penalties. So should a plan not be able to meet those performance measures, we have a very similar structure on how we're assessing the penalties. And it's much more significant than it was previously. And then moving on to the PPOs. Last year, we started our PPO Strategic Alignment Project, and that was really spurred to understand what were the cost drivers in our PPO and how they compared to the HMO. And so through that work, that was really helpful to start the foundation of our solicitation for the next 5-year PPO contract. The 5-year PPO contract is 1 year after the HMO contract, so it's for years 2025 through 2029. So with that, we've been talking with a variety of different vendors. So there's a lot of new vendors in the health industry, and they offer a lot of unique services. And so we're trying to learn more about that so we can see if they have a potential fit into the CalPERS health program and specifically into our PPOs. And so as we do the solicitation, we want to make sure that some of these potential vendors out there that do very specific condition management or member services or behavioral health services, that they'll be able to identify themselves in our solicitation and be able to submit a proposal to bid on participating in our program along with a primary third-party administrator, which is currently Anthem for our PPOs. The other thing we're doing in advance of the PPO solicitation is talking with other large purchasers. And so we're talking with large purchasers, both public and private, who have recently done solicitations themselves. In those conversations, we're learning about what has worked with them, how they have incorporated or not incorporated some of these additional vendors or outside vendors into their services that they offer, and then also how they hold the different entities accountable. What's interesting is that we are in a self-funded PPO plan, and that's what we have. And so sometimes it can be tricky to hold the health plan or the third-party administrator accountable for containing costs as well as improving outcomes. So we're working with other purchasers to figure out what are the right performance guarantees we might consider incorporating into our contract the next time it comes up, which will be in 2025. So with all that, we have a lot of HMO work going on right now, and we'll be bringing it all to the Pension and Health Benefits Committee in March. So this is where we will talk openly with everyone about what was submitted, who submitted, what their proposals were to CalPERS, and then we as a team will bring forward our recommendation on what plans and products, service areas, as well as potential benefit design changes we recommend the board adopt for the 2024 plan year. So that's coming up at March's PHBC, so I encourage everyone to attend that. There'll be a lot of information shared, and we'll see where we're headed for the next 5-year contract for our HMOs.
Thanks, Rob. And thank you for teeing up Julia's question. You had mentioned clinical quality measures. Julia, can you give us a few examples of some common measures and then talk a bit about how it is that CalPERS chose the quality measures that it did for our new contracts?
Yeah, sure. And clinical quality measures can be very technical and somewhat dry, so hopefully I'll add a little, breathe a little life into them because they're so important. Clinical quality measures really are a window for us as purchasers to see what's happening between a clinician and their patient, and to make sure that members are getting the high quality care that they need and that they deserve. And there are literally thousands of quality measures, and they're sort of broken down into 3 categories, and I'll just hit them really quick. They're process measures. So an example of a process measure would be, is a person with diabetes getting tested for diabetes? They're outcome measures. So as a, to continue the diabetes example, is a person with diabetes having good control of their diabetes? So that's an outcome measure. And then there are member experience measures. So is a member getting the care and the experience of care that they feel that that is high quality for them and what they need. And so what we did, and Rob mentioned it, as Lisa mentioned, that we started working with Covered California and the Department of Healthcare Services, which administers the Medi-Cal program, to really focus in on what is important, not only for our 1.5 million members, but Covered California's 1.5 million members, and then Medi-Cal's 13+ million members. And so what measures have the greatest population health impact? And so I'll just go ahead and tell you what these measures are. And so there are 5 measures that we all decided on. The first is blood pressure control for people with high blood pressure, control of diabetes, so is a person with diabetes having good control over their sugars, colorectal cancer screening for those members over the age of 45, childhood immunizations, and that's for, we have 200,000 plus children in our CalPERS health program, so our children getting the immunizations that they need. And then there's a maternal health measure, so making sure that a mom gets prenatal care and postpartum care in a timely manner. And I just wanted to give you an example of sort of blood pressure control, because I think it really shows the impact that it has on our members. So if all Californians, so this is not CalPERS members, but if all Californians with high blood pressure received good blood pressure control, so their blood pressure was within the normal range, over the course of 4 years, we could prevent, as a state, 16,000 deaths, 27,000 fewer strokes, and 15,000 fewer heart attacks. And those numbers and what we could do to prevent those numbers are really why we chose those measures and why we hold our plans accountable to have good control over those measures. And I just sort of think about it as a physician. If I could prevent one heart attack, one stroke, one death, it would make my career, so to prevent those thousands of heart attacks and strokes is just like, would, just really be so impactful for all of us and make such a difference to our members. So that's the why behind the measures.
Thanks, Julia. That real-world example makes it much more meaningful. Rob, I think we have one more question for you about the health plans. How is it that you determine what plans are right for to be included in CalPERS portfolio?
Yeah, so to determine if a plan or which plans are the right mix for the CalPERS portfolio, we look at a variety of different factors. So one of the factors we look at is cost, and so that's kind of a no-brainer. I mentioned this earlier, and so we want efficient and effective plans in our health program. And so this is why we evaluate the administrative services fees that they charge to administer the services to all of our members. And it's not just about a low rate here. We don't want just the lowest administrative service fee. We also want transparency in what is in it. So what are they charging for? What are they paying for a variety of different factors that build up that ASF as we refer to it. Another factor, of course, that we look at is quality. So Dr. Logan talked about this. We want to make sure that we have high quality health plans in our portfolio. We don't want to have lower performing health plans as an option for any of our members because they could actually have better outcomes if they were in a better plan. So we want to have a very high bar for monitoring the quality efforts and actual performance of the health plans over a period of years. Another factor that we also look at is to make sure it's kind of the extension of quality is making sure our high cost and high needs members are taken care of. And so these are the ones that have multiple chronic conditions, they need a lot of care and they need the right care right now. And so we want to make sure that the plans do a good job of managing all the various conditions they have so it can help improve the outcomes and also help lower costs so the members aren't getting ineffective or unnecessary treatments. And of course, we also look at service areas. So do the plans that we have in our portfolio provide adequate service and adequate availability for our members everywhere where CalPERS has members, so the entire state and also beyond. And so sometimes that's tough to do in some of our rural counties, so we have to make sure we have the right mix to get the plans in there. Another thing that we also look at is not just the availability of the plan, but also of the providers and also of the medical groups that they contract with. So we want to make sure that our plans, our members have access to a variety of different high quality and affordable providers and medical groups throughout the state. So it's a multi-factored kind of approach we take to look at what is right for the portfolio and what plans might not be the best fit to participate in the CalPERS Health Program.
Thanks, Rob. It really is quite a balancing act there with a lot of factors to consider. I think in the interest of time, we might transition to a different area. Yesenia, switch to you and talk about another area of interest for the audience, and that's how we're working to enhance our members' experience of their health care. We know that member experience and engagement are critical to ensuring healthier outcomes for our members. Engaged members result in healthier members, better health outcomes through improved patient safety and improved quality of care, and of course that leads to reduced costs of care. So for all those reasons, this remains a critical focus for CalPERS. So Yesenia, can you tell us how CalPERS is helping members navigate the health plan choices that they have and try to simplify the complex decision-making around searching for a plan?
Of course. So like you said, our goal is to help our members make informed decisions, and we want to make sure they have the tools and the resources that they need to make these decisions. And one of our greatest tool that we have is our search health plan tool, which is available in My CalPERS. And through this tool, you can compare health benefit design, such as service areas, co-payments. You can compare premium costs, as well as search for doctors and specialists within your geographic service area, so you can make the best decision for yourself and for your families. And to show you how easy it is to use this tool and search for a doctor and make changes, we've created a quick tip video that walks you through step by step in utilizing this great tool. Another way that we're ensuring our members are aware of the health plan choices that are available to them and communicate any benefit design changes that are coming with the new contract year is we communicate extensively throughout the year, and we do this through open enrollment material. We send out custom member communication, as well as our health publication, such as our health benefit summary, which is updated annually. And this publication also provides a comparison between our health plan types and provides a listing of which plans are available within each county. And for our employers, I wanted to mention, we held a special webinar for you last September, which was very well attended, where we went over open enrollment information. We answered questions at the end of the presentation live, and we were able to address those questions timely, so you were prepared to handle the open enrollment period before it started. And then the last thing I wanted to mention was some new functionality that rolled out last September, which provided our active employees the ability to submit their open enrollment transactions electronically through CalPERS with employer approval, of course. And this is something that our retirees have been able to do for several years now, but we were pleased to be able to extend this functionality out to our active employees as well. And we saw a significant increase in the number of transactions that were processed electronically. It more than doubled from what we had seen in previous years. So that was really great to see. It streamlined the process for our members, as they weren't required to submit documents or forms to their employers. They could submit everything electronically online. It streamlined the process for our employers as well, for those that chose to use it. But we're always looking for feedback. So we are completing a employer survey through the end of July. And we're going to be using that feedback received from the survey to look for any opportunities to enhance the process. For our members, we also surveyed our members, and that survey period completed at the end of December. And the results were positive, with 86% of our members expressing that they were really satisfied with the new functionality, as well as stating that it really made it easy for them to submit their open enrollment requests. But we're also going to be evaluating their feedback to see if there's any opportunities for improvement there as well.
That's wonderful. Thanks, Yesenia. That was a great overview. And I need to watch that video.
It's online. It's on our website. If you haven't checked it out, I recommend that you do.
Thanks. Can you tell us more about the changes and enhancements that CalPERS is working on to help improve the members' experience of their care?
Yeah, like I mentioned, we are always looking to see how we can improve our tools and our resources, so our members are well informed of the benefits that are available to them, and so to make those informed decisions and pick the best plan for them. So this year, we are enhancing the Search Health Plan tool to provide the ability to search for Medicare doctors, as well as behavioral and mental health specialists, and medical groups such as, Dignity Health, UC Davis, health physicians, stuff like that. So this new features actually came from you, our stakeholders, the idea. And so it's something we've been working towards for quite some time. So we're really excited to be able to roll out these new features this year, just in time for open enrollment. Some other stakeholder feedback that we received regarding the provider information is that there was certain instances where the information was outdated or at times incorrect. So we worked with our carriers to increase the frequency in which we were receiving the provider information. So that will help towards improving the quality of the provider information that's within the tool. So these features and these enhancements that we're rolling out later this year is going to improve the member experience, as well as also provide that added layer of information to help our members continue to make more informed decisions, again, for themselves and their families.
Thank you, Yesenia. In fact, thank you so much to all of you for your thoughtful responses. We really appreciate it. And now we are going to move into our question and answer session. So we have the mic in the center aisle there. If you'd like to ask a question in the room, come on up and share your name and your question. And then after we hear from somebody in the room, we'll check in with David about the Zoom, and we'll kind of go back and forth so we can hear from everyone. Go ahead, Larry.
So, good afternoon, an excellent presentation, a lot of good information. I appreciate it. So I have about, I don't know, maybe three questions. One pretty quick, but one is, and to the point that you were just talking about, I had written down, the information shared on your website is really important in terms of providers, and the provider search is a great function. There's a law that passed a few years ago that said that the insurers had to post on their websites, available providers in their system, as well as whether they were taking new patients or their practices were closed. And I know that's been, it was difficult for them right off the bat. I'm just wondering if you've had any recent look at that in terms of accuracy and how up to date the closed practice announcement is.
Yeah, so that's a good question. Appreciate it. Appreciate the comment part in it as well, because you're quite right that the big challenge with provider directories is they become stale as soon as you put them out, or at least there's always a risk of that. And what I can say, and this is in the encouraging category, the Integrated Healthcare Association out of Oakland, it's a nonprofit that is working on a handful of different sort of technology advancements for a lot of consumer-facing aspects of healthcare, has been putting together a tool that would allow this to happen in real time. So they've been working with insurers and large health systems to add to this list, so that ultimately, where we can get to is a place where it will be in real time. Because it is, when I was at Health and Human Services, we had this concern, and we, for a very short amount of time, secret shopped. So we just pick up the phone and call to see if providers were actually seeing patients. It's a tool that I think CalPERS has used from time to time also, but that's not where we want to be, right? To sort of identify the problems and what you've already put out. So we think that this will be an advancement. We've been working with them closely for help in how we do this ourselves. So the goal is there. The technology is not quite there, but it is getting there.
Yeah, and very important with 80% of primary care providers having closed practices. So, following up on another point that you made, Don, is there's good news that there's high-cost drugs coming off of patents. Now, I don't think there's been any patent legislation on that, on the gaming that they play on this. And what they do is they'll take that brand name drug, they'll give it a minor tweak, they'll relabel it, it'll get a new brand name, and they keep the price about the same. Can you speak to that at all? Has there been, maybe there's been some progress, maybe there's been, I haven't seen any patent law changes that address that.
I'm not aware of patent law changes. It's definitely something that we've had a lot of conversations with Optum about this, in particular, as the class of drugs that I mentioned are coming off patent, because there's so much money in that space, and And, and some of the competitors that you're seeing are manufactured by the same competitors that had the original patent. There are other competitors in those spaces now. So there's, this is one, in this particular instance, where we're going to be watching it like a hawk. Will some of that take place? Almost certainly, I would imagine. But there's so much, there's likely to be enough competition, so we are pretty confident that we're going to see decreases in prices in that space.
Right. Yeah.
It's not a solution across the board. In other places where, frankly, there isn't as much money, you might still have challenges, but we're modestly more optimistic about the market working there than we have been in other places.
Great, great. Okay, and then my last question is for Rob. And so as you're going out for new contract for the self-funded plans, I've had complaints from members, and I personally have a complaint about the EOBs that are sent out, the evidence of benefits, right?
Yeah, evidence of benefits.
And they're almost useless. They provide a little information, but not the important information we need. For example, they don't give the name of the doctor. You have to go look on your calendar and see, well, is this the doctor's appointment they're talking about? That would be a simple fix. And then the service descriptions are very vague, so you can't really tell what you're charged for. And for those of us that are maybe a little more, involved in this kind of stuff, they ought to have the code for the service. The dental plan, Delta and the Department of Managed Care, Department of Managed Care requires maybe it's DHS, but requires the code for dental services be on your EOB, and we get that. But, there is, we know, fraud that occurs, and, we could be the first step in regulation if we knew a little bit more about what these things meant. And it's interesting because when you get Medicare billing, EOBs for Medicare, they have the codes and more information. And so it would be good to have your contractor provide that. And I'll stop there.
All right, thanks for that comment and suggestion. So no, I'll take that back. And this is the time to put what we want from our next third-party administrator over the PPOs as well as the HMOs into the solicitation, so we know what we want to get out of this one to help improve the outcome for our members, and then just not the engagement, but the experience for our members too, so they know what's going on and make it easier for them. So thank you for that.
Great, thanks. All right, since I don't see anyone behind me, I'm going to ask my last
Larry,
question.
go ahead.
Don, you mentioned the winds of, the winds, and a lot of the drivers of healthcare costs that you mentioned are, fairly new winds. And two that you didn't mention that have been long-standing is private equity takeover of healthcare and verticalization in healthcare. And is there, I think you've tried to, address the verticalization, but I'm very concerned about private equity. You heard me yesterday, and I just think even in your own investments, I can't tell. It looks to me like you've got a lot of private equity money invested in the same companies that are, buying out hospitals and nursing homes and so forth. So
I'm unfortunately the wrong person to ask about the particular companies that we're investing in, because that's not my expertise or my day job, and that's not to say that that it isn't the case somewhere, but I just don't know.
Well, the transparency would be, just to know would be good.
Certainly. You know, we had I had a conversation with the person who was running that portfolio a few years ago, and he thought at the time that the exposure there was not as significant as in other places, but it wasn't quantified in any way. It's a reasonable question. You know, on mergers and acquisitions and consolidation generally, you know, one reason I didn't mention that is I feel like I mention it every time I talk about healthcare costs, because it's such a driver, and it's so frustrating to see where California's gone over you know, the last 15 years. You know, when I left here to go to DC in 2009, the healthcare market was completely different. Sacramento and the Bay Area were terrific, highly competitive markets, and now Sacramento is struggling, and the Bay Area is certainly not a competitive market, not as competitive as it was. And
North, south.
South is still better. There's still a lot more competition we're seeing in the South, but we're seeing far lower prices in the South. And as I've said before, you know, you see a 2-to-1 difference in price with no corresponding difference in quality when you move from some parts of the state to others. And that's not just rural urban. You know, a lot of those areas that are now the highest cost places are not the places where you have provider shortages. They're just places where providers are able to charge higher prices because there's no competition, and it's a problem, and it's costing us a fortune. So it is something that we need to keep an eye out. We work regularly with the Attorney General and the FTC where we can to help make sure that these kinds of transactions are getting the kind of review that we think they need to. We need stronger tools. We were supportive of the bill last year that gave the Attorney General stronger tools. We're hopeful that we'll see that reemerge in the legislative session, but in absolute agreement that is a real challenge for the delivery of high quality and high value care in California.
Thank you very much.
Thank you both. Do we have anybody on the line, David, that we have time for here?
Yes.
Great.
Yeah, this is Tom Considine with California State Retirees. And the question's for Don Molds. Don, I understand you've been appointed to the board of directors of the Office of Healthcare Affordability. Do you anticipate CalPERS to be working with that new entity in identifying cost drivers and eventually setting target costs and enforcement and so on?
Yeah, thanks for the question. So my position was named in the legislation as in an ex officio role. So CalPERS, we're actually unique in that we don't have a vote. That isn't to say that we can't be helpful in trying to get to a good outcome. So I'm really excited about the Office of Affordability. It is the first office California has had. It's focused solely on addressing many of the issues we were talking about just now and earlier. It's modeled after several of these similar offices that we're now seeing in other states. So in Massachusetts, in Colorado, where they've made a good strides in bringing down healthcare costs. So you know, there are a lot of challenges facing it, but it's I will say that the administration has taken their responsibility very seriously. They've sort of rejiggered what used to be OSHPD into an office that has got a broader mission. They've brought on some really terrific folks from agency, some outside people to advise. They've done a handful of early briefings for all of the board members, including the ex officio board member, talking about timeline and you know, there's the the legislation lays out a time frame for doing this, so it all doesn't happen overnight, but gradually the goal is to agree upon appropriate cost inflation, and then where they don't see it, they have some tools to do something about it. So it's going to be an exciting thing to watch and certainly participate in, and it's definitely one of those things that's going to be good for CalPERS.
Thank you.
Thanks, Don. And unfortunately, we've hit our hard stop at 3 o'clock. So thank you all for coming and for the thoughtful questions, and thank you to all our panelists.
I will say here that the request by her manager for her to take a pregnancy test has no place in a California workplace or your investments. UFCW Local 1167 in Southern California recently filed an unfair labor practice charge with the National Labor Relations Board, alleging that Cardenas terminated Ms. Martinez for protected activity and that Cardenas threatened other workers with discipline if they communicated with her. Cardenas's labor record includes other concerning examples under the tenure of its current CEO before Apollo's acquisition. In 2021, without admitting wrongdoing, Cardenas settled a class action lawsuit alleging violations of the California Labor Code at a settlement cost of $6.5 million. Cardenas also had run a strong anti-union campaign telling workers a union is a bad idea for Cardenas markets. These examples make your investment policies on fair labor practices so important, and we ask you to hold Apollo accountable to them at Cardenas before CalPERS commits to Apollo Fund 10. In short, we believe Apollo should resolve Cardenas's labor issues and respect Cardenas workers' right to freely choose whether to join a union before you invest additional funds in Apollo. Otherwise, your next investment with Apollo will reinforce Cardenas's bad labor behavior in California, potentially expose your investment to possible labor risks, and undermine your policies. Thank you for your work.
Yes, can you hear me? Okay, so Rosala is gonna say it in Spanish and I will translate it.
Okay. Buenas tardes, mi nombre es Rosalba Martínez y trabajé en la panadería de Cárdenas Market en San Bernardino, California, hasta que me despidieron 2 días antes de Navidad. Entiendo que han invertido en Apoyo, que es dueño de Cárdenas Márquez, Quiero contarles mi historia porque creo que deben saber lo que sucedió en su inversión. El jueves 1 de diciembre estaba enferma y vomité en el trabajo. Entonces un gerente me acusó de estar borracha. Me pidió que me hiciera un alcoholímetro, una prueba de drogas e incluso una prueba de embarazo. ¿No es eso una violación de mis derechos? ¿Cómo se sentirían su gerente si le pidieran que se hiciera una prueba de embarazo? La gerente quería que me fuera de la tienda con alguien para tomarme estas pruebas. Después de preguntarle quién era la persona con la que quería que me fuera para tomar esas pruebas, la gerente me dijo que me fuera a casa. 2 días después, la compañía me suspendió sin goce de sueldo. Luego de 3 semanas después, Cárdenas me despidió y me prohibió el entrar a sus tiendas. Cuando me despidieron, les pregunté qué pruebas tenían. La gerencia me dijo que no tenían que mostrarme ninguna evidencia. Cárdenas no nos trata con respeto. Trabajé ahí durante 2 años y gané un poco más que el salario mínimo, 15.75 por hora. Gané alrededor de 26,000 el año pasado. Quiero que sepan que disfruté sirviendo a los clientes. Quería poder pagar mis cuentas y cuidar a mi hijo sin intimidación ni maltrato en el trabajo. Creo que los inversores también deberían querer. Podríamos hacer mucho más por Cárdenas si nos trataran como seres humanos en nuestra comunidad.
Okay, my name is Andrea Garcia and I work for UFCW. And I'm reading Rosalba Martinez's statement. It says, good afternoon, my name is Rosalba Martinez and I work in the bakery at Cardenas Markets in San Bernardino, California, until I was terminated 2 days before Christmas. I understand you're invested in Apollo, which owns Cardenas Markets. I want to tell you my story because I think you should know what happened in your investment on Thursday, December 1st. I was ill and I vomited at work. Then a manager accused me of being drunk. She asked me to take a breathalyzer, a drug test, and even a pregnancy test. Isn't that a violation of my rights? How would you feel if your manager asked you to take a pregnancy test? The manager wanted me to leave the store with someone to take these tests. After I asked her who that person was, the manager told me to just go home. 2 days later, the company suspended me without pay. Then 3 weeks later, Cardenas terminated me and banned me from the store forever. When they fired me, I asked what evidence they had. Management told me that they don't have to show me any evidence. Cardenas does not treat us with respect. I worked there for 2 years and made a bit more than minimum wage at $15.75 per hour. I earned about $26,000 last year. I want you to know that I enjoyed serving customers. I wanted to be able to pay my bills and take care of my son without intimidation or mistreatment at work. I think that's what the investor should want to know, would want to. We could do so much for Cardenas if they treated us like human beings in our communities. Thank you, Rosalba Martinez.
Joanne Hollander, go ahead.
Hello, everybody, and thanks for all the hard work. I really appreciate it. I want to thank you for your effort to get a Medicare physician provider listing tool coming up. You know that's a very important thing, especially I live in the Bay Area where doctors don't really want to take Medicare patients because they don't get paid enough. It's a very high cost of living area that we're in. And also a lot of the medical groups are buying up making all these groups larger and larger. Like, for example, John Muir just recently finished purchasing the entire San Ramon Medical Hospital. So it's like, it's very, very hard to switch to another plan. And I'm in a PPO, and I just did some research since the presentation yesterday on the ACO REACH. And I do use John Muir Medical Center and group, and they are an ACO, And I was just wondering, with our PPO plans with Medicare, are we going to be using the ACO REACH as part of the requirement for the next year health plans? Because I clearly would probably be in a group that would be switching over to the REACH since it's a requirement if they're a voluntary group. So I'm a little confused about it all, but I wanted to express that concern because I really need to know where you folks are coming from. The meeting yesterday was, a lot of opposition by the stakeholders, but I didn't really hear a position taken by the board members. And I know they weren't there to vote, and it was educational, but I think it's important for us to know where you're coming from, since you are already looking and putting out requirements for the new plans in this next year's bids. So could you address that, please, Don Moles?
Joanne, this is in the public comment period right now, so we're not going to be able to reply, but we will get back to you offline, okay?
Okay, David, I appreciate it because I think this is a big deal. And it was a big deal yesterday in the meeting, so I would appreciate some kind of feedback. Thank you.
Certainly. Thank you. Kelly, I understand we may have another person calling in. If so, go ahead, please.
Yeah, David, we have two callers. First, we have Lynn Mittler, retired STRS.
Go ahead, Lynn.
Yes. Thank you. Hello, I'm Lynn Mittler. I am a retired teacher with the CalSTRS pension, and that does mean that my health care is under CalPERS, so thank you very much. I am very concerned about climate change, so I read a lot. And I just spent yesterday reading Banking on Climate Chaos Report 2022. It was published in March 3rd of 2022, and a new report will be coming out, I guess, in March of this year. There are 5 preceding reports. This report is an eye-opener. It is a collection co-authored by Rainforest Action Network, Bank Track, Indigenous Environmental Network, Oil Change International, Reclaim Finance, Sierra Club, and Ergwald. It is a very comprehensive global analysis of fossil fuel banking covering the 6 years since the Paris Climate Accord. It documents the shocking discrepancy between what the banks claim publicly and their actual financing of the fossil fuel industry expansion, including $742 billion in 2021 alone. And the reason I bring this up is I had been studying CalPERS and realizing that you invest in JP Morgan Chase, for example, which is a bank. And it is one of the top banks that this report addresses for its involvement with fossil fuels. So this report shows that 4 U.S. banks dominated the financing: Chase, Citi, Wells Fargo, and Bank of America. And Chase also provided Gazprom with $1.1 billion in financing in 2021, as our government asked all companies to withdraw their support to Russia. So I would love to be able to email you the link so that you too might look at this report. It's very well done. It's got all kinds of graphics and ways of understanding things. To reconsider your investments in Chase Bank, for example. Thank you.
Thank you for your comments. All right, Kelly, we're ready for our next caller.
Yes, David, we have Eddie Isaacs from SEIU Local 1000.
Go ahead, sir.
Good afternoon. My name is Eddie Isaacs. I'm a member job steward, SEIU Local 1000, and a state employee, Department of Transportation. So I'm a CalPERS member, active. I wanted to ensure that CalPERS board ensures that environmental social goals are considered in their investments. It would be climate change, reduction of fossil fuel usage, alternative, green technologies, and so on, so that investments not only for the fiduciary responsibilities of CalPERS, but for the betterment of society overall are considered. And leading investment firms, leading corporations in America and beyond are following environmental and social goals as part of their mission statement of their corporations, as part of nonprofit organization, and then their leaders, and whether it be equity, economic equality, or environmental justice, that environmental social goals are considered in the investments of CalPERS and its actions toward its members and retirees. I appreciate your time today. I yield the balance of my time.
Thank you for your comments. Kelly, any further public comments?
That concludes public comments. Mr. Takehart.
Thank you. And that means seeing no more here. Oh, doesn't show on mine. Okay, we got a couple more on the Zoom. One moment. Jeffrey. All right, let's go with Jeffrey. You go ahead and unmute.
Thank you. Thank you. Can you hear me okay?
Yes.
Yeah, I apologize. I was not able to get in on the last discussion as I was in my car. And I have reached out to staff, but my request today is getting support with a third-party administrator on the Delta dental plan. I'm retired and will be 70 this year. And the concern I have with the plan for retired people is the annual payment benefit of $2,000 is the same for a retired person as it is as a younger working member, which may seem fine. However, for a person like me who begins to have dental problems as we age, as you know, a surgical procedure, an extraction, or an implant can completely wipe out the $2,000 benefit. So I have to ask you, with your third-party administrator in mind, CalHR, is this really designed well for a retired person when a benefit for one or two procedures can wipe out the entire year? So what I'm asking is, would you please have yourselves, because I've contacted Delta and they said that their contract is with you, CalPERS, not CalHR, but I understand the administrative part. So I would like you to begin looking into a new plan that increases the benefit, the annual benefit, from $2,000 to a higher level that seems reasonable as we retired people need more dental work. Thank you.
Perfect timing. Thank you for your comments. All right.
Thank you.
And Jerry is still there. That's not public comment. So I believe that concludes today's meeting. Thank you very much. We're adjourned. I don't know if a board member.
David?
Oh, Jerry, now, Jerry?
No, this is Brian Berger. Can you hear me?
Yes, I'm not sure where you're coming from, but yes, if you'd like to offer public comment, please go ahead.
Yes, I had submitted a comment to you by email regarding the PERS law that restricts divorced employees after they retire, and they are only allowed to name a new beneficiary if they are awarded 100%. And my question was, what is the reasoning behind allowing somebody with 100% to name a beneficiary, where someone with 90% is not allowed to name a beneficiary? I found I was asked the question and was given the government code, but that's all it says. And then is there a cost of CalPERS? I can't figure out what it would be. The person has already lost their survivor continuance portion of their benefit because you have to be married to that person when you retire. So if you get married after divorce in retirement, that goes away. And you're only talking about the smaller beneficiary portion, which you don't get to name a subsequent beneficiary for unless you're awarded 100%. If anybody has any comments on that, I would sure like to hear an answer as to why.
Mr. Berger, I'll confer with the leaders over that area and get a little bit more insight, and staff will be responsive soon on that, okay?
Okay, and I would also like to comment on the Jeffrey that just commented on the Delta Dental Plan. The $2,000 is the same benefit as existed in 1995. It has not gone up. The state contributed about $89 in the PML I found from 1995, and it's only like $139 or $145 now for the current PPO plans they have. So it's barely gone up anything, and the $2,000 benefit has not gone up. And the dentist used to be, members used to number around 95%. Now it's around 65%. And that leads to more and more dentists dropping out of the plan, which makes it extremely hard to even find a dentist. It's kind of like the health plan, finding a dentist that's accepting any new members. And the dentist told me that he ends up rationing care because he can't provide good dental health for his patients because they tend to ration their care based on the $2,000 limit, which does need to be increased.
Thank you, Mr. Berger. Appreciate that. All right, Kelly, are there any more calls? No. Okay, seeing no more in the room. Okay, we will be adjourned.